All right, y'all. Grab a seat. We'll get rolling today. Welcome in, welcome in. Let's get this mic figured out. Welcome to Free Fun Friday. Yeah, good to have y'all here. You can clap it up for all y'all making it. Good job. We got Eric here from Vegas. Woke up at 1 a.m. Drove just straight from Vegas to be here. And one speeding ticket in Schwab County. Yep, those guys are sticklers over there. Here we are. And can you guys help me get some more cord on this? I can't move. I don't want to pull it all down. Anybody beat that? Anybody beat Eric? Came from a further location. Last time we had a guy flying from Atlanta to be here. We had another guy looking to fly in from Toronto. So anybody else though? Everyone else Utah? Okay, sweet. Southern Idaho. Okay, out of state. There you go. Left at 5:30. Yeah. Yeah, that's awesome. Well, welcome in. Good to have you guys here. So today, to set the groundwork, so what we're going to do today, you're like, what are we doing here in this, basketball court? What we're going to do, we did one last month. People loved it, and we said, let's do another one. So the way we want to run this, I get a lot of people that ask me for help on their funds. If they DM, Bridger, can you help me buy funds? We have a full company here, Fund Launch, that helps people launch investment funds. We've launched hundreds of funds over the last few years. This is what we do a day in and day out. We launch funds. We have a full incubator program. We have courses and stuff and videos online and stuff. We help a full, and I'll talk more about this, a whole gamut of people launch funds. A lot of people ask me, Bridger, can you help me with my fund? And so we just said, you know what? Just come to the office. Let's just do one day a month. Just come by. We'll whiteboard stuff out. We can brainstorm. We can do all stuff. So we threw one last month called it Free Fun Friday. Most people will charge to do a workshop like this. People will charge thousands of dollars sometimes to come by and do a workshop. And I was like, let's just do it for free. Our mission at Fund Launch is to democratize Wall Street. I want more people to understand this game. I run 2 funds right now. It's been an amazing vehicle to be in. I want more people to understand what this game is. So I was like, just come to the office. So you guys are here. It's awesome. Good to have you all here. I want to make today pretty interactive. You guys came. You were there last time. Yeah, you were there last time. I want to make it pretty interactive. I want this to be very beneficial. So you guys cool with that? Yeah. So psychologists tell us that if you show up to an event like this and you guys help me. Oh, thank you so much. If you just show up and listen, you will remember about 0% long term today. If you show up and take notes, you will remember about 2 to 5% long term. If you use your body and voice and you work together, you'll remember about 15 to 17% long term. So I'm going to invite y'all, introvert, extrovert, whoever you are, to engage. Does that sound good? I'm going to have a lot of time where you're going to meet. You have some really, I know a number of you guys in this room. There are some really great people already in this room. So I want you guys to meet one another, talk. We're going to share. I'm going to invite you guys to participate. Does that sound good? You guys cool if we lock in? Okay, I love it. We'll talk about funds and have a great time today. As a little preamble, let's just do this, and I'll get things queued up. If you can, stand up for me. I'm actually going to have you guys maybe move forward a little bit, and you guys move forward as well. I want you to stand up, get in groups of 3. And I want you to answer the question. So sorry, I'm having you guys move and think for the second. So move forward a little bit. Get in groups of 3 people. And I want you guys to just meet one another, say hello, and then talk. Why did you come today? What are you looking to get out of today? Why did you show up? What are you trying to learn or get out of? Why would you come today this morning? Does that sound good? So grab a group of 3, say hello, get talking, and get going. Just find a group. You can be in 4 group. That's fine. Yeah, come join a group of 4. Welcome. That's all right. Yeah.
High interest rate.
Okay, keep switching. Make sure everyone gets a chance to talk. 45 more seconds. We'll wrap it up here. If you're just walking in, come grab a spot. We're talking, why'd you come today? To introduce yourself. You guys can meet one another. Why'd you show up today? Why'd you show up? All right, start wrapping up. Make your way back to your seats here. 20 seconds. Start wrapping it up. Wrap it up. All right, grab a seat. Grab a seat. Come forward if you can. Grab a seat. Grab a seat. All right, thank y'all. Like I said, I'm going to come on back. Come on back. Come on back. Okay, pretty fun. Good to see y'all. Welcome in. Just shout out for me. Why'd you guys show up today? Anybody want to share? Just quickly. Doesn't have to be long. Why show up today? What were you hoping to get out of today? We can make a little list here too. What were some things that you were like, man, I'd love to talk about that? Scale? I'll write some of these down. Wait, real quick. Scale in what sense? Scale in what sense? So scale in particular to multifamily. Cool. So in real estate, multifamily. Okay. Sorry, and Eric, you had something? Cool. So, yeah, how does a fund work? How do you structure one? Very cool. What else? So what, like, which direction to go for in specific to like which fund to do? Cool. So what type of fund to do? Like how to manage a fund, how to actually run one, and like day to day, like how to. Very cool. I love it. The team, yeah, how to put together a team in a fund. Very cool. What else? What else would you like? We're making a good list here. Yeah, go ahead. Using a fund to fund another project or another fund. Okay. So like a fund of funds, maybe. Fund of funds. And how does that work? Perfect. I love it. What else? Incubator, like a hedge fund incubator. Very cool. I'll just keep going down here. I'll put hedge fund. I know my handwriting is phenomenal. Can you guys even read that? We know what it means, right? We're all here. We know what it means. Sorry, I cut somebody off. Somebody else was saying something. Yeah. I love it. Licensing, and then also fund versus syndication. Yeah. Oh, between those two, cool. Okay, we can do both. Yeah. We're calling it to a single asset fund. It's kind of we're changing the vernacular a little bit. Syndication, there's so many different types of syndications. We're calling it more a single asset fund. So one deal at a time versus like multiple deals at a time. I love it. Good list. What else? Yeah. My crystal ball. Oh, it's often broken. It's usually very broken, but I'll share, dude. I love sharing. If you follow me, I'm like, I'll share what I think, and then it's like always wrong. But no, just kidding. We have had a few good calls though. We've had some good calls on where we think things are moving, and it's actually interesting to watch where right now with tariffs, whole international trade right now in the world is on fire economically. So where's that going to lead? But crystal ball. Anything else? Anything else we're missing here? Yeah. Yep, I love it. I'll put cash flow in regards to lending on real estate. correct? Okay. Cool. We got a good list here. Anything else? Probably a lot more. What? Anything else come to mind? Like, man, I'd love to get that out today. Pretty good list. By the way, we'll hit some of these as I go. We'll probably check some off, and then we'll go Q&A, whatever. Welcome in. Good to have you here. We'll have some good time. Sound good? Search fund. We can put it on here. Yeah, throw it on. How does a search fund work? What even is a search fund? You know, how does that all work? I love it. Okay, like I said earlier, today I want to make this pretty interactive. This is a workshop. This is not here for me to just talk about something. I want to make this really interactive. We're going to bring in Lincoln in a few minutes, my business partner with Fun Launch Partners and Fun Launch. We'll talk about it. Very good, excellent. I got the iPad here. We can just talk for hours. Sound good? You guys cool? Okay. Thank you all for participating and coming in. I'm gonna share a little bit groundwork on like funds, why funds. It might answer a few of these questions, and then we'll probably open it up for more some topic stuff. We'll just dive into certain topics that are useful to you guys. Sound good? And I might have you guys share. I'm gonna have you guys take notes. I probably will have you guys take notes and write down stuff, and maybe even build out something for your fund as well. Sound good? Decent plan for today. We'll try to wrap up by for sure noon, maybe even earlier, and we can just bleed out into Q&A. I can hang out, answer questions, whatever. Sound good? Cool. Okay, let me share. You guys can see my screen, obviously. Here we go. So let's talk about funds. Let's talk about where the world is right now, actually. So obviously, the last time we did this meeting, it was a week before Liberation Day, April 2nd. And I brought it up on the screen. Do you remember this? I was like, do you guys know what's happening next Wednesday? And everyone's like, no, I have no clue. And I'm like, it's Liberation Day. It's April 2nd. Like, no one knew this was coming. I'm like, dude, Trump has been tweeting about this for a month. And then, lo and behold, Liberation Day hit, and markets, have swung like crazy. So we saw some of the biggest drops down in recent history, right, in the market. Furthermore, we've seen huge swings in the bond market. So if you guys saw April 9th, when they put those Chinese tariffs on, there was major swings. So the 3 days before, bond yields. So yields with bond prices are directly correlated. So the more bonds sell, the higher the yields are. And the more people buy bonds, the yields go down. Okay, they're directly correlated. They're like tied together. So we saw the weekend before a lot of people buying bonds. Okay, so yields were dropping. And they were dropping at a major rate. Bond market is pretty steady market. It was swinging drastically down. 3 days later, right as they hit China, we saw the exact opposite happen. Major selling of U.S. bonds, which you would theorize maybe China was dumping. They're the second largest holder of treasuries on the planet Earth, dumping their treasuries April 2nd to kind of punch back the United States. So we saw this April 9th. Treasury yields. Now, we're just theorizing. We don't really know. It could have been Warren Buffett as well. Warren Buffett holds sitting on like $304 billion of treasuries right now. He could be dumping as well treasuries to get back into the market and buy in. We don't know. We will know probably in a month or two what actually happened because they have to report on their filings. So it's been some wild swings. That day was the day that Trump then tweeted in the morning, today is a good day to buy. Do you guys remember this? Crazy day, dude. This was like the craziest day of my entire life. He's like, it's a good time to buy. And I'm like, looking at the market. The market's like sold off like crazy. I was up at like midnight watching. I was looking at charts and stuff. I was like, this is weird. Like, what is going on? And then the next morning he tweets. And then like, 11:30 a.m. he goes, we're putting a 90-day pause on tariffs, right? We had like the biggest single day gain since 2008, which was crazy. Anyways, it was pretty fun. Our Black Card group, which is our internal group of fund managers, we were all talking and chatting about this. It was very interesting to watch all this movement. So we've had that. Now the market's kind of been up and down. We've had a few good rally days. The gold market has added roughly $13 trillion in the last 18 months, which is bonkers. Gold was about a $12 trillion market cap. Now it's at like 25 trillion, roughly. These are rough numbers. A lot of that money has been sucked out of equity markets and bond markets and has just fled to gold. We will see. Right now, it's rumored 80 countries are negotiating with the White House on trade deals. I'm hopeful that things go well. We got Trump, obviously, Howard Lutnick and Scott Bessent, very smart individuals working on it. Scott Bessent was arguably one of the best hedge fund macro traders of all time. He's like in that category. He was with Druckenmiller and Soros when they broke the Bank of England back in the 90s. He was like the analyst that helped them do that. And he's now our new Treasury Secretary. So very sharp dude. These guys are sharp. When people say, I said this before, when people are like, they're so stupid, they don't know what they're doing. Have you ever heard people say that? Like, Jerome Powell's such an idiot. Biden is such an idiot. People say this. Trump's such an idiot. I go, I think idiot's the wrong term. these are the people who run the greatest superpower the world's ever seen, left or right. They're not stupid. They're not stupid individuals. Now, they might tell you one thing and do something else. They might sound stupid on the teleprompter or whatever, but watch what they're doing. The actual behind-the-scenes game is very interesting. Now, they might be misguided. They might be evil. Those are fine words to use. But like, oh, they just don't know what they're doing. I'm in Lehi, Utah. I know how to do it. It's like, really? You know? Twitter Joe. So I always go to the next. I operate under the assumption that people are very smart. I operate the assumption that countries and these individuals running the world's superpowers are pretty smart individuals. There's a reason they're there. So what are the moves they're making, and why are they saying it this way? Why is Jerome Powell doing X? Why is Janet Yellen, the previous administration, doing Y? What's the end game? What are they playing towards? My dad and me and my brother wrote a book called Dollars, Gold, and Bitcoin. Talks about market manipulations happened over the last 2 decades. We've had Barclays back in 2007 got fined $300 million for manipulating the LIBOR price. We had my dad. He's like, he looked up in 2018 there was roughly $13 trillion trading at 0 or negative interest rates. He's like, I don't even know what a negative interest rate is, right? And he started looking at this, and it grew into 20. And I'm getting the numbers a little bit wrong. 2019, 2020, 2020, it just grew this number of 0 or negative interest rates. He's like, I have a friend in Denmark. To give you an example of what a negative interest rate is. He's like, I have a friend in Denmark. He had an adjustable rate mortgage. You know how they adjust up and down? His mortgage went negative. The bank was paying him $25 a month to have a mortgage. That's a negative interest rate. You know, you buy a bond and you get a yield, like you get a 4%, 5%. A negative interest rate is, I'm buying a bond and you just hold the money, and I'll pay you a fee for holding the money. It's very interesting. It's a strange world. We've seen a lot of these strange things happen. So how do you make sense of a world that we're living in, right? So welcome, and you guys can come grab a seat if you'd like. It's a very interesting place to be in. And then you go forward, Janet Yellen, right, and the Biden administration spending $1 trillion every 100 days. I mean, we've seen major inflation around the globe. Now, what's interesting is we've seen inflation in the United States. The rest of the world has seen inflation as well. They're also, and it's worse than us, right? They're printing just as much money as we are. So you're like, man, the whole world is printing currency in a huge way. You know, Trump administration's tried to slow it down, but they really haven't. I mean, M2, which is the global money supply, has just been on a rocket ship the last little bit. Generally speaking, when M2 money supply goes up, global spending, that money has to find a home somewhere. Generally speaking, it flows into assets. And those assets in nominal terms go up. In real terms, it's, you know, the same, but like inflation adjusted, it's the same, but in nominal terms, things go up, like gold, like Bitcoin, like real estate, like equities, like, you know, pretty much anything, because there's just more dollars to go around. Does that make sense? This is why it's pretty fun to be a fund manager in today's world. There's a lot of dollars being created every day, flowing into all the assets that you guys are looking to purchase or buy or be in. Just by the nature of the market we are in, those assets will probably just go up in value over time anyways. Now, can you find alpha? Can you find a risk-adjusted rate of return for those assets as well and build on top of that? It's a pretty good, fun space to be in. You can aggregate capital together to go buy those assets and get more of those assets in an inflationary environment. It's a pretty cool place to be. So, welcome to Free Fund Friday. I mean, this is a very timely thing to be a part of. Being a fund manager in this environment is extremely fun. It is awesome. So, is that making sense? Any comments? Yeah, you had a question. Yeah. Yep. We'll use this microphone real quick so people can hear you.
I was all over Europe in summer of 2022 after all of our inflation was happening. And we thought our inflation here was bad. But I went to Turkey and their inflation was 75% a year. In Greece, it was 65% per year. And it was just like they were hurting. And it was just crazy. I was just sharing that.
Well, yeah, thank you. We think it's just the United States. This is not in the United States. It is all over the globe right now. And people are trying to slow it down, and we've increased rates, but the European Central Bank just cut rates. We'll see if Jerome Powell cuts rates. Markets are pricing in about an 88% chance he doesn't cut rates in the next meeting in 2 weeks. So we will see what happens, but it's anyways, pretty interesting time right now with what's going on macroly around the world. And if you think a little bit longer term in terms of 3 years, 5 years, 10 years, 15 years, where does this lead? We could be going through. Sorry, you guys are getting me talking here. I'm just going to keep going. They're calling it a Bretton Woods maybe 2.0 that might be happening right now. Do you guys know the Bretton Woods Agreement? So 1944, near the end of World War II, 44 countries from around the world flew into Bretton Woods, Connecticut, and they essentially reorganized the world trade. It's called the Bretton Woods Agreement, and essentially what happened from that agreement, the United States was the only country left on Earth with a navy. And what we said was, hey, we have a navy. We will protect all of your shipping lanes. So we will protect everybody. We will become essentially, everyone's like, why is the U.S. the world police? It's because we agreed to be the world police back at the Bretton Woods Agreement. And after that, we said, we will protect all of your shipping lanes as long as you trade with us. And everyone's like, do we have to pay? Like, what's the catch? Like, the catch is if you can use our currency, the dollar, that would be phenomenal. And then over time, it got more assertive that, hey, you just use our currency. We'll protect all of your shipping lanes. We'll pay for a navy. A navy is one of the most expensive things a country can buy. It's extremely expensive to have a navy. We have 11 super carriers right now that have 2 nuclear engines on them. They can go for like 100 years and not stop. I mean, our aircraft carriers are crazy. A cool fact about aircraft carriers, and I'm getting on little threads here, but one aircraft carrier by itself would be the 3rd most powerful air force in the world. Number 1 is the United States Air Force. Number 2 is China. Number 3 is one aircraft carrier from the United States. Okay? So when we park an aircraft carrier off of Israel, the Gaza Strip, right? We just parked our brand new Ford-class carrier. It's like the 3rd most powerful air force in the world just parked off your coast. And everything goes, oh, shoot, like this is serious. When we park one in the Red Sea, we park one in the South China Sea. You can kind of, sometimes they tell you where these aircraft carriers are. It's a big deal when we move our carrier fleets. And then when an aircraft carrier moves, by the way, it goes with 15 other ships. It's like 2 battle destroyers or submarines. It's like a full aircraft carrier. It's called a strike group, I believe, that all flows together. It's crazy. We decided we do that. We pay for that because people use our currency, right? That was the Bretton Woods Agreement. Now, if you've studied like the Fourth Turning, Ray Dalio, they always talk about these 80-year cycles. We're hitting that right now. There's a chance they're calling it the Mar-a-Lago Accords that could be going on right now. We will see I'm hopeful it comes out well, but roughly 80 countries right now are negotiating with the United States for new trade agreements around the world to kind of reset a new world order of trade. Now, I don't know. We can just theorize right now. It could be tariffs. It could be not tariffs. It could be us versus China. There's a lot of theories out there on how this will work. I don't know. We can just theorize here, but that is what could be emerging here in the next 90 days. I mean, this is monumental stuff that's going on. Now, there's a chance they just de-escalate, doesn't go out, but from what at least I'm studying, it feels like there could be this, a massive new shift in the world order of trade. And we're living through it right now. Generally speaking, every time we've had one of these world order of trade shifts, the next decade following, next 2 decades following, is usually booms, absolute booms for certain countries that benefit from those trade agreements. I would assume the United States would probably end up favorable after this trade agreement. But who knows? We'll see. We're the largest economy in the world. We're the consumer of the entire world. So far, we're doing pretty well still. I know there's been a decline in the United States, but where else are you going to go? You're going to go work with China? They just canceled all IP law and copyright law? Probably not, And so I'm hopeful. All that being said, we're sitting in an amazing opportunity. 2025 is a crazy time to be alive and to play in this game. Is that feeling good? Yeah? All right, I went a little too long on that, but we'll dive in. Okay, we're going to talk about funds. We'll go fast. I'm going to set a little groundwork here for funds, how funds work, how they're built, and then I would love to. We're going to talk about these. I'm going to bring Lincoln on stage to talk about. Anybody want to talk about capital raising today too? We're going to talk about capital raising. We'll have a fun time with that. Sound good? Yeah. If you're with me, say yes. All right, let's do it. Okay, real quick, so you know who I'm talking. Who's me in 60 seconds? You're like, who is this guy on stage? Just real briefly, just so you know, I know what I'm talking about. I started 2 funds in college with Blackbridge Holdings. Some of you guys know my story. I'll tell it very briefly. My dad, I had no clue, had any money. I went to college. I started 6 businesses my first 2 years of college. I went to BYU. And we grew up in nothing bad, but just a normal household. My dad just drove a car with a dent in the door. And my dad, he comes to me and says, Bridger, you're kind of like a chicken with your head cut off. Go talk to my business partner. This guy could really help you out. And I'm like, okay. So I drive over here into these hills up here. There's a beautiful, huge mansion. I pull up to this mansion. It's gorgeous. He's got a basketball court in the basement, pool in the backyard, cars, the whole deal, right? I pull up, I knock on this guy's door, I go meet with him. To make a long story short, we sit down and I go, how did you get all of this? Like, how did you do this? And he goes, we run investment funds. At the time, they're managing $8.5 billion of real estate. This is like I don't know, what is this, 8 years ago, 9 years ago? And I was like, wow. To put that in perspective, Grant, you guys know Grant Cardone, Cardone Capital? At the time, that's 2 times bigger than Cardone Capital was then. Today, I think they're near, my dad and him is now retired, but I think they're near $50 billion. They're 10 times bigger. They're 10x Grant Cardone. This is the size of their funds, okay? Which is just crazy. So I meet with this guy. I'm like, hey, can you be my mentor? Can you teach me? He goes, go talk to your dad. Your dad knows way more about this than I do. I said, no, my dad's kind of broke. You know, drives a car. You're in this nice house. I want to learn from you. And he goes, Bridger, sorry to break it to you, but me and your dad make about the same amount of money. And my chin drops to the floor. I was like, huh? Like, come again? He goes, yeah, me and your dad are pretty much equal business partners in this. I left the dude's house. I went straight to my dad's house. I was like, Dad, what the heck? Like, why haven't we been able to, like, we don't go on vacation for like 4 years at a time because it's too expensive. And yet you're managing billions of dollars in these funds. Like, what's going on, you know? Anyways, he kind of laughs and smiles. Like, yeah, my business partner likes to spend his money. I like to save my money. And, you know, I'm more conservative. But, yeah, we run these big funds. So he started teaching me about funds. So I would go to his house every Sunday night. We'd talk about funds, he taught me about funds. In college at BYU, I had an opportunity as an internship. And I saw where we could launch a fund for this company and finance their clients that were coming through this business. That was a great idea. I took it to my dad. We built this whole thing out. I was super excited. We got it all launched. We're ready to go. And I'm like, crap. Now I got to go raise money. Like, who am I going to find money from? And I thought, I'll go pitch my dad. Duh. Like, he doesn't spend his money on cars or vacations or boats or anything. Like, my dad's probably got millions of dollars saved away. I'll go pitch him. So I went and pitched my dad for money. Some of you guys have heard the story before, but I'll keep saying it because here we are. I pitch my dad for money. I sit down and I say, Dad, how would you like to be our first investor into our fund? And he kind of smiles and laughs and says, if I invest in your fund, I would ruin the experience of you raising money on your own. This is a crutch that you'll never be able to recover from. And if I do this, you will, this will put you on a bad, route in the future. And so anyways, he says no. I went out, hit the streets. I talked to everybody I knew. I raised a whopping $49,500 for my first fund. So teeny fund. I was 22 years old. But it was enough to get started. We launched this first little fund called Blackbridge Holdings. I got a 64% return to my first investors, which is good. So good amount of return, but really small fund. We then dovetailed that into a second fund. That second fund I ran for 3.5 years. We raised and deployed millions of dollars over the next 3 years in this small debt vehicle. Did extremely well. Our cash on cash returns were 62, 47, and 36% cash on cash return to our investors, which was awesome. We then had a competitor come and buy us out with Blackbridge Holdings. I run a company called Fund Launch briefly, and then I'll skip that for a second. I currently run 2 funds right now. Ugly Unicorn is a blockchain investment fund, so we do a lot with crypto. We manage about $25 million in crypto assets. We've done extremely well there. So this is an old slide. I got to update it here. And then GP Stakes, we run a company called Fund Launch Partners. We just raised a $30 million close. We raised about $20 million of that in the last 60 days. So I'm going to have Lincoln come in a minute and talk through that capital raise and how they raised all that money here just right now. They're raising it, and they're in Lehi, Utah. How do they do that right now? Of equity that they've raised, that'll allow us to probably get up to maybe 150 million of AUM under that brand. So that's pretty cool. We're now investing into funds that come out of Fund Launch. So during all this, people started to ask myself, my dad, my brother. My brother's an investment funds attorney. How do you guys do funds? What are funds? Like, what does this look like? So we started making content online, which dovetailed into a course, and now we have a full incubator called Black Card. So we have about, 1,200 people in Black Card right now? Something like that. We have 1,200 people going through our incubator in Black Card. Black Card's not cheap. It's $20,000 to maybe $45,000. We incubate. We have 8 different law firms. We have pitch deck designers. We have 15 coaches that help you go and launch your fund. We have a full software CRM that you use. We've launched roughly 300 funds in the last few years through Black Card. So that's what we've done with Fund Launch. Does that sound good? Give you a little reason why I feel like I have somewhat authority to talk on the subject. We've done a number of funds. We've all done them unconventionally. I didn't go to Harvard. I didn't go to Ivy League schools. None of us did. We kind of did this the untraditional path, and now we've helped a lot of people do the same thing. Sound good? Okay, so why funds? We live in interesting times. I talked about that a second ago. I love this quote. Watch what people do, not what they say they do. There's a lot of people online. If you look at these kind of people, Grant Cardone, Cody Sanchez, maybe you've seen some of these people, Ty Lopez, Pace Morby. Do you guys know what they all have in common? They're big audiences. Okay, they're online, they're influencers, they're teaching something online. The other commonality, they're all starting funds. A lot of these online influencers, they teach you how to do website building or whatever, and in the background, they're running funds. I know this because they call me. Like, hey, how do I do a fund? I'm like, okay, let's build it out. A lot of them are building funds. Right here, Grant Cardone, he's a sales trainer for years, now runs $4 billion Cardone Capital. Cody Sanchez, contrary thinker, she's doing private equity, buying small businesses. Have you seen her online? Pace Morby, I just was with him a few weeks ago. We were together with him. He's raising a $100 million fund right now. He's the seller finance guy, right? He's raising a $100 million fund. And then finally, Ty Lopez, he raised his fund before they bought Pier 1 Imports, Radio Shack. Kind of crashed and burned, to be honest, their fund, if you followed them. But anyways, the point stands that they were running funds. Alex and Layla Hormozy, they actually bought our program. This is before they were famous. We went to Bear Lake, went boating with them. They came to Utah. We hung out with them. And then they blew up. I haven't talked to them since they've blown up. But we were friends before that. And, what are they doing right now? Private equity. They're buying businesses. This is what all these people online that are teaching, they all are ending up in this fund. So I was with Russell Brunson a few months ago. He is on an acquisition spree right now. They've bought a number of businesses right now through ClickFunnels, and they're acquiring businesses at mass. This is the route that a lot of successful people are going, is into this fund space. Is this making sense? Yeah. Okay. I'm gonna kind of speed up and go fast, and we'll get some of these questions. Sound good? We'll go fast and slow. So they're all starting funds. This is kind of this path that they are on. Now, there's a common thread that a lot of them go, and a lot of us, I think, can go on, and we'll use this framework for a while, is you test with your own money. So maybe let's take like trading, like you're trading options. A lot of guys test with their own money. They then syndicate or do like a hedge fund incubator. We're going to talk about that in a minute, with a small group of money. And then a fund would be doing it with a big group of money and doing this over and over and over again. Okay, that's kind of the progression that most people go on. Not all, but most. You can jump into this, you can jump to a fund or jump to a syndicate, but most people go on this kind of progression. Now, we already hit this. These are a few guys that we've helped do this. So our last investor, this is Jason, said he got $51 million. This takes us to $60 million of our $100 million raise in Texas. This is Heather. She found a couple different people doing private credit, $15 million in a private credit fund. You can see right there, if you can kind of see that. Excuse me, it's kind of small. This is Kaloa. This actually, he's in Utah. You guys been up here to the Hilton campus? If you see right here, they're building a $500 million campus. They bought a $100 million deal in Park City. Huge commercial space. Kaloa, he actually spoke at our event last year. Awesome dude here in Utah. The Waldorf up there, if you've been to that hotel, that's his hotel that they bought through a fund that we helped them structure and put together. So we know a little bit about what we're talking about with in regards to fund. This is my family. It's my beautiful wife and son, Jonah. So my goal today is why you should consider launching a fund. And then we're going to talk through actually mechanics and why you're doing this. Now, there's two different types of people that do this. And I raise a hand real quick. Who's a business owner? And then there's investors that want to scale. Who'd be more like the business owner side? Who currently runs a business? Okay. And then who's more the investor side? Like and maybe you can say you're a little bit of both. You can do two hands if you'd like. Cool. I like it. This is for either group. We help both groups who want to scale. I'll give you a few examples of ideas, kind of get your brain spinning, and then we'll do some more breakout stuff. We'll talk a little bit more. So, oh shoot, I was going to get through here in a second. I'll come back to this in a second. So, we had a guy in our group. He was flipping 4 houses a year. We set up a fund with him. The next year, he flipped 72 homes. I like sharing this example because it shows how many guys in real estate? How many people in real estate in here? Okay, a few. Let me ask you this question. So he was flipping 4 houses a year, doing well. The average house flip makes $65,000 per flip. So he's making about $200,000 a year flipping houses. Professional house flipper, done this for years. He calls us up. He's like, what if I did a fund? What would that look like? So we structured it together. We put it on paper. We built this whole thing out. The next year, he flipped 72 homes, okay? Scaled quite drastically, as you can see here. But I'll ask you a question. House flippers or real estate people, if you had a fund behind you, do you think you would close faster or slower? Pretty obvious. Probably faster, right? That's an obvious question. Do you think banks would give you better or worse interest rates? Probably better. You're a repeat client, right? They'll probably give you better rates. Do you think you would... per house flip, do you think your cost per flip would go up or down? Down, economies of scale. Because you can have the same paint guy go to every house and paint all the houses. He's probably going to give you a volume discount. The same carpet person. Oh yeah, you know what? You're going to do 10 houses. Yeah, well, you know what? We'll drop your fees so you get an average cost per flip goes down. We could keep doing this, but if you follow along, so someone that runs a fund. So sorry, I'll take you back for a second. Anybody bid on a property before, and someone's outbid you, and you look at it and you're like, they overpaid. Anybody said this before? I've done this a number of times. I was bidding on a duplex like years ago, and somebody outbid me, and I'm like, they overpaid. They don't know. Because I've got my spreadsheet, and I've got my pro forma, and my pro forma says I can pay $472,000 with hard money and whatever financing, and they're paying $580,000, like another $100,000 over. I mean, it was a big jump. This is back when like the market was really hot, and I was like, they're gonna lose their shorts. You guys have done this before, right? Maybe they're not playing the same game that me and you were playing. Maybe on their pro forma, they have lower cost of debt. Their debt's cheaper. They get lower cost to do the flip, right? Because they get a volume discount. Furthermore, when you have a portfolio of homes, 72 homes, could you bundle that portfolio together and sell it as a portfolio to somebody else for a multiple? Yes. So right now, if I jump back, we are seeing this at scale. We are seeing a number of funds take over the world. Some of you guys I've shared this before, but in 2021, 1 in 7 homes was purchased by Wall Street. 2022, 1 in 5 homes. 2023, it was 1 in 3 homes purchased by Wall Street. Where are all these cash buyers coming from? Funds, big funds. There's a handful of funds taking over the world right now. If you see BlackRock, State Street, and Vanguard combined manage roughly $22 to $25 trillion. They are the largest shareholders on, I think, 475 of the Fortune 500 companies. I mean, it's bonkers. What's the job of a CEO? Increase and return shareholder value. That's the number one job. If you're Tim Cook, the number one job is increase and return shareholder value. And when your largest shareholder, Vanguard, calls you up, or BlackRock, and says you need to push an ESG agenda, guess what you do? You push an ESG agenda. This is what BlackRock did back in 2011, I believe. And every Fortune 500 company all of a sudden had ESG initiatives. You guys remember this? Like, out of nowhere, how did all these companies, all of a sudden, everyone's doing all these ESG initiatives? It's because their largest shareholders demanded it. They run the world. And then in 2021, I believe, BlackRock came out and said, well, that was kind of a mistake. It didn't work as intended. People did all these loopholes and getting out. Like the intention was good, but the actual execution was pretty bad on ESG, which is environmental, social, and governance initiatives within companies. It's pretty interesting about who runs the world. If you look at industries that are consolidated, TV, news, food production, we're starting to see more industries getting consolidated here. So car washes, dentists, food franchises, real estate, social media accounts. We are living in a world of consolidation right now. Many social media accounts me and you follow are owned by the same people. I'll give you a few examples. Michael Bloomberg, when he ran for president in 2020, do you know they bought like 50 to 100 social media accounts? They just left them, but they actually bought these they were meme accounts, most of them. They're buying meme accounts and just, hey, you just keep running your memes, but then slip in some pro Michael Bloomberg propaganda to your people. There's rumored right now, we'll see if it's true, Mr. Beast sold to Disney for like $8.5 billion. This was like last year. Then they came out and said it wasn't true. It is true. It's not true. There's been whistleblowers. We don't really know, but that's the stuff we do know. These are an independent YouTube channel. Rumored that it's owned by Disney. Interesting. And actually, if I go forward, you can look at the media giants. We think we're watching TV and media from different people. It's generally the same groups that control pretty much everything me and you think. Disney actually bought 21st Century Fox. So it's actually the 5 media giants control every brand me and you kind of see. Here's food and food production. Mass consolidation happening right now. Here's car companies. Here's the brands that are all controlled pretty much by the same groups. It's kind of, I'm going through this fast, but kind of freaky. How many of these, like who would have thought Maserati and Alfa Romeo is the same company that makes Ram, Jeep, Dodge, and Chrysler. It's the same company. It's FCA. It's kind of weird, huh? Your Jeep and Maserati are from the same company. Kind of weird, huh? There's mass consolidation going on. So how do we play in this game? There's been a major rise of retail investors, the actual people. I think that's why we need more people to launch funds. This is why I preach. This is why I do a free fund Friday. I believe more of us need to understand the fund game, how to play in this, how to understand whether you're going to invest in these funds or maybe launch your own funds, how this game actually works. Now, you might say, well, Bridger, you're part of the problem. You're helping people launch funds. Maybe I am. But I'm not okay with 3 funds taking over the world. I am okay with 10,000 independent funds all competing against each other and making a competitive marketplace. Does that make sense? I'm okay with that. I'm not okay with State Street, Vanguard, and BlackRock running the whole world. Does that make sense? Where you're going to own nothing and be happy if you follow the World Economic Forum, right? Which Klaus Schwab, that's kind of weird this week, right? Any room? I don't know. I get that. I got to go down the conspiracy. If you guys know the World Economic Forum, Klaus Schwab, he's like the head of that for what? Decades. The Pope dies Monday, and then Klaus Schwab just resigns like hours later. No press tour, no speech. He just submitted an article like, I've resigned. I don't know. That's freaky, dude. I don't know what's going on. I'd love to hear, like, I don't know, get down that rabbit hole, but we'll see. Anybody have any rabbit hole on that? Coordinates with the end of the world and all the Illuminati and all these different groups that all work together. Yeah. You can use this.
Anyway, I was just reading it last night. I mean, supposedly the Pope dying was the last seal that needed to happen for all that, and then Klaus Schwab stepped down to usher in the new world order that he's been trying to do for decades. So how much of that is true? Don't know, but...
Interesting. Well, we'll see. I don't know. Go watch some Alex Jones if you want. I'm sure he's got it all figured out. He really does, though. Actually, to give Alex Jones credit, though, man, the dude is hit. He's missed on some, but, man, he's hit on a couple, really well. You had a hand up, yeah. Yeah, yep.
Not even buying just small and medium-sized businesses, just giants buying giants.
Yep.
It's kind of scary, honestly. It's like, is there going to be 3, 4, 5 producers every industry that can run the world? I wonder if
How do we play in the game of mass consolidation that's going on right now?
Yeah,
When you're in a small fraction industry, yep.
Like the cycle looks like, do these big companies, do they eventually fail and then break up and the cycle starts all over again? Or are we headed to a new world order where, anyway, just
I love it. Let's actually talk about that right now. That's kind of dovetailing into what we're doing. Great question. Yeah.
I think everything's about to shift in ways very unexpected, even for the most Illuminati people, between AI, bioengineering, robotics, blockchain. It makes things a little more fractionalized again.
Quantum computing, yeah.
So even if they had a 1,000-year plan, it's also bugs, and we're kind of resetting. So
It's a dynamic game, right? There's multiple things happening together. So you mentioned the divergence of technologies. We have roughly, you can number them, but 10 emerging technologies right now that are all converging together at the same time. You mentioned AI, quantum computing, blockchain, robotics, 5G. You can go through like the 3D printing, all taking effect. Bioengineering, yes, biotech. It's crazy, and they're all helping one another, and it's creating a new world order as well. And then we have a new world, people trying to create a new world order here, and then consolidation happening all at the same time with mass money printing. And obviously Trump, which I mentioned in the beginning, was they're renegotiating world trade right now. Okay, so we have this very dynamic game that we were playing in. How do we play in this game? How do we survive? The first thing I'll say is learn some of, at least if you can, the rules of the game or how they're playing the game. How do I think a little bit bigger and differently? I'll actually share an example for a second. Let's talk about this. My business owners, okay? I talked to a guy, and I'm going to hit on your question here. So I had a friend call me up. He has a gun store. Gun store business calls me up. He's like, Bridger, I want to buy out my competitors. Like, how does this work? He goes, should I raise? I'm like, well, you got a couple options. You could raise equity, kind of like Shark Tank. You could 20% of my business, I'll raise $1 million and we'll go buy the competitors. You could bring in debt. You could bring like an SBA loan. You could bring in other bank financing. You could do like a seller financing. Or I said another option is you start up a fund. I think I've on my next slide. Oh, it's not here. A fund on the outside here that buys out your competitor businesses and rolls them together. And then contracts your original gun business to help manage the stores because you're good at managing the gun stores, right? And so, I'll go here for a second. For you guys that are in business, his gun store is here. So I'll put GS for gun store, okay? We're going to start an outside fund. He also owns the fund with investors. Investors put money in. He just runs his gun store. His gun store does about $10 million a year. Just leave it as is. It's good. Don't mess with it. Start an outside business, a fund. You raise whatever money you need. We then, let's see if I can. Okay, you know, I'm going to go a little bit slower with the markers. I don't want to mess up my whole shirt here. All right, so he takes the fund. We're going to buy the 3 or 4 competitor businesses. We're going to do M&A activity. These businesses are now owned by the fund, okay? At the end of the year, money flows back to the fund, and maybe you do a distribution or dividend to the investors on how that runs. But I said, you're good at running gun stores, right? The fund is going to contract you for a fee to help us run the gun stores. You know, staff them, employment, supply chain, and you can put your branding on all these stores. So now in a certain, I won't tell you where he's at, but the region of the United States, it looks like he has a complete monopoly on the market. Now they're owned by different groups, but he puts his branding, he runs the stores effectively, he now owns and controls that whole market. Is this making sense? John D. Rockefeller, right? Own nothing, control everything. If you're wondering, how do people play like at a bigger game? Like, how does this work? That's one way it works. Let me share another example actually from Rockefeller. I'm reading his book right now, 38 Letters to His Son. Have you guys ever read this book before? John D. Rockefeller wrote 38 letters to his son, John, and they compiled it to a book called 38 Letters from John D. Rockefeller to His Son. It is phenomenal. If you guys don't know, John D. Rockefeller was the original oil tycoon of the United States. Became the richest man in the world, one of the richest people to ever live. And I'll tell you 2 stories. This is side note. He tells in one of the letters like his origin story. He goes, he grew up poor, and a photographer came to school one day to photograph all the kids. And they all went out. They were so excited to see this photographer. They all came out. This is John D. Rockefeller telling his son. He's like, he goes, this photo I have is the most prized possession that I own. And this is like the richest man in the world, right? He's saying this photo he has when he was a kid is the most prized possession ever. He goes, let me tell you the story of what happened. So the kids all line up. The photographer has them all there and says, you know what? This one kid in the front, John is your name. Your clothes are too ragged and tattered. Can you step out of the photo and we'll get a picture of the rest of the students? They make him stand out, and he watches his fellow schoolmates get a picture. And he said in that moment, he's like, I determined I would be the richest man on earth. And he goes, I have no hard feelings. I wasn't sad for myself. I just set a determination. This will never happen again. I'm not going to feel sorry for myself. I'm not going to pity myself. I'm going to go make it happen. And he goes, I still have that photo of my schoolmates. And he's like, I love my schoolmates. They were my best friends. I have it on my desk today, like 50 years later. I love that picture because it set me on a course in my life where I would go like take over the world. Isn't that kind of crazy? That's like his villain origin story from John D. Rockefeller like 100 years ago. It's just like crazy, right? So let me share an example. I talked to a guy yesterday about the same thing. So he was in the HVAC business. So he's like, I run HVAC companies. And I was on a podcast. He's like, hey, should I go buy these businesses? Like, what should I do? And like, is it a good investment? And I'm like, well, maybe. I don't know. And he goes, well, a lot of guys are doing this. This is a cool thing. It's a fractured industry. Have you heard of this before? Like a lot of people right now are buying these boring businesses. I was like, yeah, it could be good. But I said, make sure you're thinking through the second and tertiary effects of entering this market. He's like, what do you mean? And I go, well, for example, you're in a fractured market, which could be good for you, meaning there's old systems, you can update things, you can do stuff. However, if you don't try to play bigger in this market, someone else will. To your point, like, what do you do if something's being consolidated? I said, if you took a playbook out of John D. Rockefeller, and in his letters, he talks about this. He had a competitor in Pennsylvania that started doing oil drilling, making refinery in Pennsylvania, and he's in Ohio, was his headquarters, and they're all selling to New York, okay? And this competitor comes, he goes to the competitor, he offers him money to buy his company. The competitor says no. He offers him more money, the competitor says no. He says, fine. John D. Rockefeller goes and buys up a strip of land, between Pennsylvania and New York, like hundreds of miles from farmers, overpays all these farmers to buy a strip of land so that he can block the pipeline from his competitor. Does this make sense? Competitor finds a way around it, found a loophole, still got his pipeline through. He's like, crap. So then he calls the railroads because his buddies all run the railroad company. He's like, hey, I'll pay you. Don't let him cross any of your lines because I need to be supplying to New York. And the railroads, his competitor had already talked to the railroads and already had a deal with him. He's like, sorry, we can't cross this deal. He goes, so then he's like, taking defeat. And this guy's starting to sell now to New York and is taking market share from John D. Rockefeller. So Rockefeller says, well, fine. I'm going to go to his, I guess it's like barrel supplier, like the huge drums that they hold oil in. He goes, I'm going to go to that supplier. I'm going to place the largest purchase order this supplier's ever seen. And I need it delivered in an unreasonable amount of time. So he goes to the supplier and says, I'm going to place whatever X number of barrels order, and I need you to take care of me as your number one. I'm the biggest guy in the country. You need to take care of me. And what happened was he canceled all the orders for everybody else, including his competitor. So he's like, that was step one. I wanted to starve him out of his barrel supply. Step number two, he goes, I went to New York, and I undercut my costs of oil down to a loss. We ran at a loss for months so that all of his customers would come buy from us. And we bled him out until the point that he was ready to sell, and we bought his company. Now that sounds brutal, right? Let me give you an updated example. Jeff Bezos. Do you guys know the company? I'll come back to this in a second. AWS. You guys heard of AWS? AWS, Amazon Web Services, launched in 2005, 6, 7, somewhere in there. Cloud computing pretty much runs the internet today. I mean, AWS, pretty much most of the internet runs on AWS, all the back-end servers here. Does this make sense? Jeff Bezos has a famous quote that says, your margin is my opportunity. When they entered the market of AWS, guess what they did? They built these massive data centers, huge. I'm talking billions of dollars of capital investment on CapEx. They built these data centers, and he goes, let's call it margins. Somebody was getting a 5 cents on the dollar margin, and we were going to launch and get 3 or 4 or 5 cents. We went to negative 2 cents on the margin. And what we did, we ran at a loss on purpose for 2, 3, 4, 5 years with AWS. Why? So that every customer on earth would use AWS. We'd bleed out every customer on earth would use AWS. Every competitor would be bled out, and then we could raise prices later. That's how AWS launched. So I went back to HVAC. I said, you're going to buy this nice little HVAC company nearby. It's awesome. Maybe it's going to run well. What if someone comes to town, a bigger group that has a fund behind them, and says, hey, we're entering the Lehi, Utah market. We're going to go buy up a bunch of groups, and we're going to run them at a loss for 18 months so that you go bankrupt. Or you can just sell to us. You're in a tight spot. They have more capital. They can bleed you out and literally run and take market share from you. And I just said, you're in a fractured industry. Right now, it's getting more and more consolidated. This is the game they are playing. Whether you like it or not, that's the game that's being played. So you need to figure out do you want to play that game? Do you want to leave this market? What do you want to do? And he's like, I've never thought that way. And I'm like, the secondary and tertiary effects of just buying an HVAC company, that's where it leads. Now, I said it might not happen. Your market's very fractured. There's a lot of HVAC companies. It's a big country, so who knows? You could be fine for 7, 10, 15, 20 years. That might not happen. But eventually, it probably will happen. And you can do it or somebody else can do it and take over market share. Is this making sense? And he was like, oh, dang. And I was like, okay. So what do I do? He's like, let's build a fund. I'm like, okay, let's build a fund. Let's make sure you actually approach this the right way. It comes from actually I'll just try here. An amazing concept that I love called Red Ocean, Blue Ocean Strategy. You guys heard of this before? A book called Play Bigger. I'll draw it out briefly for you. We actually, me and Jen, we met the author of Play Bigger, right? He came to that event we were at. So Play Bigger, phenomenal book, talks about the same concept. There are red oceans and blue oceans. Red and blue. I guess you can see the colors, unless you're colorblind. I don't have to draw red and blue. So he goes, what if I told you in tech, 74% of market share goes to one company? These are categories. So a red ocean would be a category, goes to one company. Everyone else fights for the scraps. He goes, take Google, for example. Google is a category king of their red ocean, which is internet search. They dominate. It's like 92% of internet search goes on Google. Microsoft launched Bing. You guys remember Bing? Okay, this is Microsoft. This is Microsoft. They have spent roughly $11 billion on Bing since 2011 launching it. That's a lot of money. Big company, big user base. They can put it on all their Windows S. They're going to come take market share from Google, right? Today, you guys know the market share of Bing? Less than 4%, 3%, something like that. It's like Google still, because they're the dominant category king. It's very hard to displace a category king once they're the category king. So the question is, what is the second largest search engine in the world? Can you guys see this, by the way? Is it like behind the stand? I can move it forward. What's the second largest search engine in the world? Nope, not Safari. Not YouTube. Yeah, it's YouTube. Sorry, not YouTube. I was going to say not Yahoo. It's YouTube. YouTube, and this is before Google bought them, YouTube became the second largest search in the world. Why? Because they were different. They didn't build a Me Too something better. They built something different in a new category, video search. And they blew up, and then Google ended up buying them. They dominate. Guess what? 90% of video is on YouTube. There's Vimeo, these other little Wistia, there's other little ones. They all fight for the little teeny market share. And this has now become a red ocean. Is this kind of making sense? Don't do something better, do something different. Create a new category. So the two great books, Play Bigger and Blue Ocean Strategy, talks about this concept when you're building and constructing a brand. So like back to HVAC, I was like, dude, I would try to build a new category within HVAC, something different. Now, I'm like, but if you can't do that, maybe it's a business you can't do it, I would try to be the biggest one then. If it's a fraction, be the one who has a fund behind you who goes and buys. Okay, last question as we finish this. What is the now emerging blue ocean that's threatening Google this market share? ChatGPT. That is the new blue ocean. It's becoming red very quickly right now of AI search. The biggest threat to Google right now is not Bing. They own YouTube. It is ChatGPT. It's Chat. And now they've launched Gemini, these other ones, because they're trying to now play in that game because they know the market share of just internet search right now is being sucked into these new blue oceans. Grok, yeah, there's all these other ones that are emerging, but that's the threat to Google right now. People are going to go search on Grok rather than searching in Google because it's so much more useful. Isn't that interesting? Make something different, not something better. Kind of cool, yeah. Okay, how are we looking on time here? Oh, perfect. Oh, there's Lincoln. Okay, I'm gonna bring up Lincoln in just a second here. Let's do this. Is this useful, by the way? Kind of been good so far. Okay, a few more examples of this. Just people playing bigger. Stock traders. We help a lot. And the last thing I'm gonna share, and then I want to have you guys think about this for a second. We'll probably write a few things down, and then I'm gonna get Lincoln on stage. You might ask the question, well, can we even play in this game? Emerging fund managers. Here's a few stats for emerging fund managers that I pulled here. This is from Preqin Research. Emerging fund managers. These are small fund managers like us. Okay, we maybe even micro fund managers, but emerging new fund managers. They did some stats on versus old seasoned fund managers. 22 out of the last 28 years, emerging fund managers outperformed existing funds. Isn't that interesting? It's like, can you play in this game? The answer is yes. Share another example. Younger hedge funds performed seasoned managers by an average of 250 basis points. By eVest Emerging Managers Report. Isn't that interesting? Now, why? It's somewhat because you're like, well, they're so seasoned. Like, what? It's a lot harder to get returns when you're over $1 billion. To get a 22% return with $100,000 is much easier than getting a 22% return with $1.5 billion. Does that make sense? Because when you have smaller money, you can work in smaller, more fractured markets. You can work in places that aren't as efficient. When you get to bigger funds, you have to deploy huge slugs of capital. Getting that type of return profile is a lot harder. Does that make sense? Now, that being said, 41% of allocators won't invest in first-time funds. You see this chart here? So 41 at the bottom will not invest in first-time funds. 10% will only invest in spin-offs only of like an existing fund. 16 will consider investing in first-time funds, and then 33 will invest in first-time funds. So capital raising is kind of interesting for first-time funds. It's a lot harder. So I'm going to bring up Lincoln in a second here to talk about capital raising. They just raised roughly $30 million for Launch Partners. That's $30 million of equity raised, and now they can go buy, that allows them to get a lot more AUM. So we'll bring him up in a second. What I want you guys to think about and maybe think through is that whole discussion on scale, right? We kind of hit, I think one of the questions was on scale for your business. Can we do this for a second? If you guys have something to write with, I asked you guys to play out at the beginning. If you can, maybe pull out a pen and paper, think through your existing business on that whole conversation of scale, John D. Rockefeller, all that stuff. What is a way that you could grab more market share and or position your company in a new market? Maybe you are in a competitive market. Man, I got to pivot. How could you be something different, not just better? Does that make sense? You got the question kind of there? So brainstorm for a second. Open up a pen and paper. I'm going to give you, let's call it 2 minutes. Just write down about your existing business or maybe the business you're getting into or what you want to start. How would you position yourself to be different? Because it's very hard to disrupt people that are different. And or you say, well, I'm in HVAC. I'm not that different. How can I scale then? How can I go and buy market share and grab market share? Sound good? Okay, pen and paper. Pull out your phone if you can. I asked you guys to play out at the beginning. So pull out your phone. Don't check Twitter or the news. Try to write down. 2 minutes. Ready, set, go. Then Lincoln, let's get you queued up here. I'll play a little music for you. How could you position your company different? How could you play in more of a blue ocean? How could you take over maybe competitors or a market share of the market that you're currently in? Think from the perspective, if you had unlimited money, what would you do? That's another question. If I had 50 million, 80 million just sitting in an account right now, how would I position myself if the goal was to take market share? Answer that question. We'll give you 1 more minute here and then we'll get started. All right, you guys got something? Give me like a head nod if you got something. Something good. I'll give you 20 more seconds here if you're still writing. All right, let's do this for a second, actually. Okay, everyone look up at me. You guys here? Some of you guys met some people before. What I'm going to do, let's have you stand up. Let's get in groups of 3. And I'm going to have you share, if you're comfortable, share some of the stuff you wrote down, something that was interesting to you. Sound good? Meet the people around you. I'm going to do this. Person with the most facial hair goes first. All right? Sound good? Person with the most facial hair goes first. Share what you kind of, maybe introduce yourself for a second. Share for, let's go a minute a person, pretty quick, but how you answer this question, how you would kind of take over, move into a blue ocean. You can take it as you want. Sound good? Okay, stand up for me. Maybe talk to someone you haven't talked to yet. So stand up, get in groups of 3. Person with the most facial hair goes first. Get in a group of 3. Get going, say hello. People in the back, you're welcome to come join and grab a group. somebody here?
Yeah, absolutely. Welcome. What's your name? Jeremy. Jeremy. Sam. Ben.
Yes, I do. Say this morning. So, looking at blue ocean versus red ocean, essentially one of my companies, I run a couple of them. We sell residential windows. It's a pretty big space. We actually have players in it. But what they don't do is have an established process, have systems, and have an entire app that's dedicated to function process of their industry. It's not something that's established in the industry.
They have to manage it like a reps or
All the above. So, in the sales process, fulfillment process, beyond CRMs, but yeah, essentially like a CRM. So the problem is that none of them have a solidified system like that. They all do paper contracts, but they're still performing. So it's but they're the stacks of paper contracts and they do it well. As well. So anyways, that's what I'm looking at. It's nuts how to do it. They're good. Anyways, we're actually turning it out.
I've actually, so I've worked a little bit door to door, and it's like interesting to see how this system is a lot easier.
Trying. That's my
And then, so what's your idea, like, how are you going to make that into a blue ocean? Are you going to sell that software to other people?
we're establishing ourselves and making
Okay, keep rotating, get everyone a chance to talk. Keep going, keep going.
I'm working with a door to door company right now in acquisition. They're like acquiring some technology. I'm sure a club. I mentioned I work with French, but because of NDA reasons, I'm not supposed to play. It's in the door to door. So, if I cool stuff. Really cool. What about you, brother? You have a little more facial hair than I do, so.
Well, what I
Start wrapping up. 1 minute, 1 minute.
So what's the name of your company?
realize there are a lot of agencies that have less than what they want to, or they want to
That's how you do it. You actually find it.
and we have a huge network. We have organizations that came up with the space that we want.
You saw it on the fundraising.
So
Just for the outside of
when we go out, say office hours, like 49,
whatever
we get some money from exactly that they don't want. It's kind of
All right, come on back, come on back. Start wrapping up, grab a seat. Come on back. Come on back, grab a seat here. Grab a seat, grab a seat. All right, come on back, come on back. Okay. Come on back, come on back. Who had somebody share something pretty cool in their group? Any nominations over here? Yeah, so everyone's pointing over here. Are you okay, Sharon? Stand up for us. Maybe come up. We'll use the mic so people on virtual can hear. So tell us your name real quick and what you shared.
My name is Sue, and I just shared that I am a criminal defense lawyer. I came from working for nonprofit and poor people. I worked for the Utah Supreme Court. We launched the first state to allow non-lawyers and software to engage in the practice of law, and I didn't see anything that I liked. So I launched my own legal tech company, and pretty quickly it became apparent that an app wasn't going to be too competitive, too much in that blue ocean. So we are building AWS for AI. Essentially, right now there's no place to deploy actual AI agents, and there's no AI agents to actually connect all your data to your benefit. So what we're building is a new platform, new base foundational tech. They'll basically put an AI bot in your data and give just a report to whatever professional is trying to help you. So, sorry, I'm a little nervous. I didn't expect to be put on the spot.
Well said.
So we have something different, but raising the foundational money to do this, foundational tech is hard to get investment in. I've also been approached because we're trying to do a matching piece to match the professional with the need. And we have a housing crisis in Utah, as you all know. It's expensive. And I've been approached by developers and real estate agents and landlords that want to actually develop affordable housing. So I'm here to learn how to do both a tech foundation in private equity as well as a real estate fund for, and both have that technological base to use your personal data to your benefit, connect your data, and be able to just give the professional a limited amount of information to help you without taking control or ownership. So small data, blockchain, AWS for AI agents to really have a place to deploy them appropriately.
Very cool. That's awesome. Are your agents going to be in the legal field?
I'm starting with legal
Starting with legal. Okay.
because that's where I work.
Yep.
And also legal touches everything. Financial data. Sorry. So I'm starting in legal because I'm a lawyer. I've practiced law for 15 years. I have not seen 86% of Americans actually don't get any help with their legal issues, and we need to stop that. We need to actually increase access to legal assistance. And part of the issue is that legal touches everything. It's financial, it's medical, it's personal. If you're going to get a divorce, I'm going to ask you how old your kids are, where they go to school, where you work, what the equity in your home is. Like, it's going to be a really robust data set, and it's a lot of information to gather. So that's why lawyers are so expensive. So building tools like predictive drafting, AI context responder, the ability to go in and get the data and do that intake with Avatar AI, right? And then I get that information, I do a draft petition, and I can help you actually match with the lawyer that's affordable for your need as well as accessible and in your local region. So I'm all over.
Time, clap it up. Well said. Thank you so much. Well put. Anybody over here have something good that you wrote down? Maybe you wrote down or somebody in your group wrote down? Anybody want to share? Yeah. Come up here, Eric. Clap it up for Eric, everybody.
How we doing? So I've been a fitness trainer for the last 10 years now, and I see that, especially online, everybody has a podcast, everybody has social media, and really what I'm seeing is that the hardest thing that, I see with trainers that want to build their business online is that they're having struggles just, cutting through the noise. And my company, we recently just started a new media company helping other trainers, help them to get more clients, help them to build their business. So one thing that I thought to, as an expansion, as an idea, I'm actually going to the licensing expo in a couple weeks in Las Vegas. And, I really liked what Pokemon Go did with getting people active. And I thought that market has really not been formed yet. So I said to myself, what if there was a way to really, take that market share and, start to license this intellectual property, this IP, and start to use it to create engaging content, especially on the fitness side, especially engaging people in health. I mean, we have a massive, talk about shortage in real estate or other areas, we have a massive shortage of medical professionals, people working in fitness. I could tell you less than 50% of schools in America even have a physical education program. So I see the intellectual property and the media side really being transformed to, we've all heard the podcast. We've all heard it 1,000 times. We don't want to be lectured. A lot of my clients, they don't want to be lectured. But if we can find more entertaining and engaging ways to create opportunity so that people are engaged with the content, people do want to get fit, and more trainers can find the clients, I think that we can expand the fitness market, expand it on the media side, and then use intellectual property as a way to grow that market, because that's something that really has not been expanded to its full capacity yet. So that's my that's my vision.
Everybody. Clap it up. Well done. Thank you. Happy you're still awake too, driving in from 1 a.m. from he drove in from Las Vegas this morning to be here, so pretty fun. I love it. Thank you all for sharing. We probably could spend more time doing this. I want to make sure we get Lincoln on stage here in a second. So let me cue up Lincoln, my business partner here, and then we're going to give him a huge round of applause. Sound good? And I'll probably have you guys stand up. We'll just bring down the house for Lincoln. Sound good? So Lincoln, my business partner here at Fun Launch, and then at Fun Launch, we had all these great clients coming out of Fun Launch and these amazing funds, and a lot of them wanted to partner with us. Bridger, Lincoln, can you guys partner with me, do deals with me? And we just said no forever. We're like, no, it's your business. You go run it. And then one of these businesses hit, 400 million of AUM? And we're like, dang. He wanted to partner with us. And we were like, nah, we're good. You go do it. And we're like, dang, we're idiots, man. Like, why don't we help this guy? And so then we were like, well, what if we built a fund around here? And we started to explore GP Stakes. GP Stakes is where we would actually invest into these people's funds and actually take a part of their general partner as a stake, and we'd work with them and partner with them with their fund, if that makes sense. It's this new emerging hot asset class. We went to the Greenwich Economic Forum last year, and it was like the hot topic on Wall Street. What is GP Stakes? How did GP Stakes work? All these investment funds on Wall Street were trying to figure out how to invest in GP Stakes. And we're like, we have the best pipeline on earth of fund managers coming up. And so this last year, Lincoln has worked incredibly hard, built Fund Launch Partners. They just closed roughly a $30 million fundraise, which will allow them to do roughly 25 deals. Last year, they did 6 deals. This year, we're looking to do another 10 deals. Average deal commitment's about $1 million. So last year, we invested into roughly six funds with an average commitment, about $1 million commitment into those funds. And so Lincoln is the guy running this, and we got Adam and a few other guys here as well. You can meet them all with Fund Launch. So I wanted y'all, a few questions we got earlier was on capital raising. How do I build a firm? How do I capital raise in this environment? Lincoln just finished this right now. He's like in and kissed a lot of frogs to find a few frogs that I guess kissed him back. So with that's my little introduction for Lincoln. Lincoln's a phenomenal person. You guys will love hearing about this. And I want him to talk all about capital raising, doing this, give you guys real tactics for this. Does that sound good? Decent plan? So if you can help me, I'm going to try to keep the music. Hold on, see if this works. Here we go. Ready? If you can, get on your feet and welcome to the stage, Mr. Lincoln Archibald. Wow, it worked. There we go. Good to see you, brother.
Thank you, thank you, thank you, thank you. All right, you guys can sit down. Enough pomp and circumstance here. No, look, as Bridger said, like we just finished this fundraising journey. Fundraising, for any of you, if you have this grandiose expectation that it's a walk in the park, let me assure you that it's not. It is a lot of work, right? Don't underestimate that. Getting people to believe in you, believe in your ideas. Now, I guess for context, walking into this, just know that I did not have this fantastic network of individuals to go raise money from when launching this, okay? I just didn't. I basically started from scratch. I didn't have, an extensive track record in the strategy that we were pursuing either. Okay, so I was really starting from ground zero, but we still managed to pull this off. And so I'll just kind of walk you through the journey of, building this fund and raising capital, and hopefully you can glean ideas and inspiration on, how to apply it to your strategy. I mean, look, but for real, guys, like I'm from Utah State University. That's where I went to school. There we go. I'm from Shelley, Idaho. I worked on a potato farm from the ages of 10 to 18. All right. So, you're not talking to this guy that, went to the Ivy Leagues and had all these big, awesome connections. I really genuinely started from scratch here, but we put it together. So, look, I mean, the first thing about raising money is you got to have a good product, right? You got to have something that is investable. And that is what we spend the majority of our time at Fund Launch working with people on is, okay, do you actually have something that people want and people can see a line of sight to invest in? You have to have a no-brainer deal, especially when you don't have an extensive track record and you haven't, managed assets in that strategy before. So like we went through several iterations of planning and preparation and, of what this would look like. We went to market originally, like, there's this, let's see, can you guys see the screen? Perfect. So I don't know if Bridger talked at all about the capital raising matrix. And if you have questions, just stop me, all right? I'm going to run here, but just feel free to interrupt me if you have questions. But there's kind of, did you talk about this at all? Okay, so there's kind of these, these different tiers. If you're raising like 0 to 10 million, let's call it 10 to 50 million, and then 50 to 500 million, right? There's different types of investors you go after based on your strategy. There is first like the high net worths, then there's the ultra high net worths, and then you've got like family offices, multi-family offices, fund of funds. Above that, you've got like your institutional allocators, all right? So when starting out, we originally said, okay, we have all of these managers to go and invest in, right? This massive community, fund launch. Originally, my first thought was, well, let's go raise $200 million and let's go write anchor checks into 20 of these funds, right? About $10 million a piece. Because I had like a network, everyone has a network here. Let's see, kind of in the high net worth, your friends, families, fools, that you all know that you're going to go try to raise money from. But I was actually, I'd worked at JP Morgan, I had worked in industry a little bit. And so I had some connections, all the way up here. So that's where I wanted to go raise from. And all I did is I put a pitch deck together. And like that was the first step. Like put a pitch deck together, go see if they like what I have. And they did not like what I had. They said, no, absolutely, like we don't need another fund of funds. Like there's already enough of this on the market, especially at emerging managers. Like that just doesn't work. And we said, okay, like scratch that idea. So we spent a lot of time iterating, the strategy, the thesis, right? What we're actually investing in. And so we spent a lot of time then crafting what our fund looks like now, which is a $30 million GP seeding fund. We said, hey, we're going to go after these micro managers, right? Those that are raising between $10 to $50 million. We're going to identify operators that know what they're doing. We're going to work with them along the way. We're not just going to be passive allocators. I started going to market, and people said, okay, this is interesting, right? Like I started getting initial good feedback, right? And it's like you go out there and you should just be asking for advice as much as possible, right? From anyone and everyone as you're getting going, and just say, what do you think about this? Is this something that you would invest in? Why or why not? And just iterate on your strategy. And so anyhow, we felt confident enough that we had the right strategy, we had the right product. Let's go raise money. So that's what we'll talk about here. So, I mean, look, there's a couple ways to do funds. You can either, let's see, I'm going to scroll down. There's like the institutional way to raise money, where if you look at this on a timeline perspective, like you go out and you raise money for 6, 12 months, and then you hold your closing, like your first close. Maybe you're trying to raise $100 million. You go out and you raise money until you have 50. And then you launch, right? Then you actually launch your fund, launch your strategy, and then you push towards a final close. You've already got 50 in the door. You go raise money. You take down your first couple assets. But usually you might do like one deal in the middle here, and then you do your final close at 100 million, if that's your target. So most people don't have institutional networks. You're not raising from institutional grade allocators starting out, right? You're starting with $100,000 checks and $200,000 checks or $500,000 checks. So what we like our thesis here at Fund Launch. I mean, we work with hundreds and hundreds of fund managers. Last year, guys, I underwrote almost 1,200 fund ones. Okay, that I look to invest in. And the strategy that is more successful is just getting started. Okay, you don't need to have all of your money raised before you launch. You really just need enough money to do one deal. So we started with Fund Launch Partners. Our first close was $1.2 million. And this was March of last year. So about 12 months ago. We put everything together. It takes a couple months to get structured, but we just launched, right? 1.2 million was not enough to do the entire take over the world strategy, right? But it was enough to get started. So we launched, and that was our first close. And then, because when you're launching a fund, you are selling the strategy, the asset class, and the sponsor. But when you're selling a deal, when you're syndicating money, just like on a deal-by-deal basis, you're just raising money for that one deal. So it gets a lot easier when you have deals in your portfolio that you can now go point to, right? Instead of like, hey, here's our thesis, here's this intangible strategy that we're going to go execute on. We got deals in the portfolio. We closed on our first 2 deals. And then we were able to go out and market those and leverage those to our second close, right? So our second close, I think, was about 3.8 million. And this is a couple months later. And, in between then, I mean, lots of fun stories, right? But, question. Great question. So you usually are lining them up in tandem. But it's more about it from a money raising standpoint, right? You want to have, look, the hardest part about raising money is you have to create urgency, right? Like investors need to, you have to get them to make a decision about whether they want to invest in you. Like, okay, like if I go back to here, like all of these guys, let's see, you can change and influence their timeline. Okay, that's key to understand, right? Anyone that's smaller than an institutional allocator, you just need to get to a no as quick as possible, right? Get them to say, no, I'm not interested, or get them to, sign a subscription document, right? Like that is the objective as quickly as possible. And you can strongly influence that. So you create these artificial timelines of they meet with you at the beginning of the month and you say, look, yeah, we're closing. Our next close is the end of this month. And you have to have the integrity to say, look, if you don't invest in this close, we're not going to let you into this fund. Or maybe we will, but maybe we're going to give you preferred economics if you close before the end of the month. So it's all about creating urgency around getting dollars in. It's important to understand that these guys, you cannot change their timeline. Okay, institutional allocators, do not try and get them in the door and get them subscribed, because look, they've got a structured investment committee in place. They've got X amount of months of due diligence. Like, they have a due process outlined. They have a committee overseeing their dollars that they have to follow, right? So it's no point in trying to go and say, yeah, look, we're closing in a couple months, we want to push this. But with, it's a delicate balance, between creating this urgency, but also being able to meet those deadlines, right? Because a lot of allocators, well, I won't go down that road, but you need to have integrity about what you're talking about. Okay, so first close, second close. You guys tracking so far on kind of the way that emerging managers should go out and raise money? So I mean, just funny stories, right? Like, so this first 1.2 is really like people I already knew, right? Like friends, family, professors, people that I had pre-existing relationships with. That's where that 1.2 million. I had to go to second and third degree networks to go from 1.2 to 3.8 million. And so I found this at the Greenwich Economic Forum. Actually, we met this financial advisor who thought what we were doing was very interesting. He's like, oh, I've got this guy, and we were emailing back and forth. And I literally think I flew out to New York. Guys, I was on a plane almost every week last year. No joke. At least 4 times a month, if not more. You just need to look. I believe, and everyone might raise capital differently. I'm just telling you what worked for me and how I did it. All right. But I believe that shaking someone's hand and meeting them face to face is infinitely a higher conversion rate than meeting them over Zoom, right? And so I would always if I would meet somebody, if I would get introduced to somebody and I thought they were a legitimate allocator, I'd say like, great, I'm actually in New York next week. Not in New York next week, but I'm in New York next week. I've got a couple meetings. Could we grab dinner on, this night? So that's what happened with this guy, Curtis. I got introduced to. This financial advisor told me, he's like, oh, this guy, he seeds funds all the time. He's a $10 to $20 million check. I looked him up online. He had seeded, he's probably deployed over $100 million, and he's a centimillionaire that's deployed into a number of, emerging managers. I was stoked. I was elated. This is post first close. I was like, I got this best lead in the world. Like, let's go close him up. Flew out to New York. I remember me and Adam were actually running around New York. I hopped on. We had a couple meetings that we were able to set up that day. And I remember I was so stressed because on the train, I forgot to change out of my running shoes. And I was like in a suit and running shoes, right? And I just vividly remember that. I'm like, what the hell am I doing, man? Like, oh my gosh, going up to Greenwich to meet with this guy. We had this nice dinner. The dinner's going great. He's very interested in the strategy. He thinks what we're doing is phenomenal. And I get to the end where I'm like, okay, so, Kurt, how much money, I can't remember exactly how I worded it, but I usually say, how much money would you be looking to deploy in a strategy like this? And I was expecting $5, $10, $20 million, because that's what all my research said. He said, no, I could probably do 250K. And that may be good, right? But my heart dropped at that dinner table, right? Like, I had done a lot of work, a lot of research. I had, I thought this guy was just going to close this up for us. This is in like April of last year. And I thought like, game over, but he's like, yeah, I could do 250K. This is interesting. But that's the reality of fundraising, right? And so I learned then, I'm like, okay, before it definitely was worth it, because this guy is a strategic LP. And I just had a call with him yesterday. He's very excited, like he's helping out with due diligence, and he's already indicated that he wants to be a sizable LP on Fund 2. That's just kind of his strategy: is start with a smaller check and then test out the operator manager and go from there. Like, it wasn't a waste of time, but it's just funny. Like, you go through stuff like all the time. Like, you might think everyone overestimates their ability to raise money. Okay, let me just be candid. All right, you have a couple good connections, you think they're going to come through, and it's so funny. It's like usually the people you're banking on coming in don't come in And then there's these guys on the sidelines that end up coming in. So the important factor is like, you just got to be out there all day, every day, meeting as many people as possible, getting in as many rooms as possible, increasing top of funnel. All right. So, okay. So we got to our second close, but yes, I leveraged a couple deals out of urgency. And sorry, what was your name in the blue shirt? Brian. So it was Brian, good question. I had queued up, another 2 deals for this closing to, kind of create that timeline closing. Now, I probably had enough capital because the way we structure our investments out of this first close to do it, but and I started small. Like I knew our target deal size was going to be about $1 million, but I wasn't starting out that way. I was starting with about 250K deal size just because I hadn't raised that much money. You got to think about what if I don't raise more money? What is this portfolio going to look like? Anyhow, we kept going. We had our third close in December and so this is how fast things happen, okay? Right? Like I worked the worst months to raise money, guys. July, August, and typically December. Wasn't that case for me, but typically December. But July, August, and December, very tough. But we held our, at the end of November, our third close at about $8 million. But mind you, it's not like I wasn't doing very much the entirety of all last year. I was having conversations all year round, right? And I'm working all of these different types of investors. I'm trying to just meet as many people here, meet as many people here, meet as many people here, and build those pipelines. And then there was this one guy that how did I get in contact with him? A cold LinkedIn message. I reached out to him. His name's Todd, and as a way to better understand my market, I started a podcast called Funds That Won, where I was just interviewing allocators simultaneously. And I invited Todd, this random guy, didn't know anything about him, but he family office, deploys money. I invited him to come on this podcast. He said yes. We developed a little bit of a relationship. He was talking about after the call, about treasury accounts and whatnot, and I can't remember. I followed up with him about something he said, and we hopped on another call and ended up kind of presenting to him what we're working on. He said, maybe. He didn't take a lot of interest, but then we had an event out in Orlando. I invited him to. We went to dinner. It was probably a 6-month in the making lead. But he ended up coming in. I would say he was my first big investor, right, Adam? He was our first sizable investor at $1 million. And it took months to work, right? I worked that relationship. But the key point being, I didn't have these relationships going into this, all right? So we landed Todd, and I always made a habit of incentivizing, and asking people for referrals. And he actually, on this simultaneous close, introduced us to another key player, a guy named Troy, who came in for $2 million on this close. So that's what kind of helped make it up. So, that $8 million close, I started swimming upstream to these larger investors. And that's something you got to do. It's very tough to get sizable checks early, right? It's good to go and have a foundation of several $1 million, because that gives new investors confidence that, hey, there's people that believe in this guy. There's people that trust this guy, right? Every dollar raised gets easier and easier, right? Because you have more momentum and more traction. Sorry, is this? Am I talking about good things here, Bridge? Is this helpful for you guys? Yeah. Okay. Do you have a question back there? Well, yeah. Well, the first thing when you're new, regardless of your pedigree, if you're an emerging manager, you have the leverage of asking for advice from everyone. Okay? There's this common phrase, you ask for advice, you get money. You ask for money, you get advice. Right? So go out and ask for advice from literally anyone and everyone. And just like I see so many people that bullshit their way and trying to look like this institutional, perfect, you have everything figured out type of profile on your first raise. But I really don't like that. I look at all these people, now I'm in the reverse position where people come ask me for money all the time. And I hate it when people are just not real, right? But if they acknowledge like, yeah, this is hard. I'm working my butt off, and we're trying to figure it out. We think we've got an idea. What do you think about that? This is my plan. How do you react to that? Right? It's important that you just don't blindly go in and ask for advice, but you present your thesis or, hey, this is what I'm working on. What do you think? It's genuine conversation where you're having them pick apart your strategy and momentum. And so I think that's the easiest way to start cultivating relationships. But I think it's also important to know when to push them, right? Like with Todd, we had worked for 6 months. I knew I didn't have a good enough relationship with him to pressure, urgency, close them in, at the end of the next month. Like you got to know when to do that, right? And so especially where we didn't have any mutual references or mutual contacts, because look, people invest in people they know, like, and trust, right? At the end of the day. So, you just got to know when to pull those different triggers. But great question. Yeah.
Are we going back to like our high school life football?
Literally, yes. When I started, I took almost every contact I had on my phone, put it on a spreadsheet. I thought back to all the previous jobs I'd had. Who had I worked with? Who do I think potentially has money? I called my childhood dentist. I called my current dentist. I called, my current lawyer. I called anyone and everyone that I thought potentially had a spare dollar. And you just have to get comfortable with no's, okay? You don't take it personally. Like, because half of the time it's usually like a timing issue for most people. It's like, hey, this is really cool, but yeah, I'm not liquid. Don't be devastated, right? Like, just be like, okay, I'll follow up in X amount of time, right? Yeah.
Easier to convert people off of a list who already know you into people who...
Absolutely. Your highest likelihood of a close is somebody that already knows, likes, and trusts you. Okay? Point stop. Right? And usually the second best person to know, like to close, is, immediate, first tier networks of those individuals. But if you're able to build a good team and get more individuals on your in your playbook that you're leveraging that are now a part of your organization, like that's what kind of was the catalyst here for this fundraise. Is this guy is a heavy freaking hitter. Okay, and everyone knew this guy's reputation. They knew, liked, and trusted him. And the fact that he was putting money into this made them feel way comfortable about putting money into this. And so we leveraged off the back there, and that led us to have a $20 million close at the end in January. Okay, because it wasn't just my reputation now. It's like, hey, look, this guy built a $6 billion fund. He's consistently, a top decile PE manager, and he put in, several $1 million. And look, there's real people in this fund. Like part of this, like people are looking for social proof, credible social proof to invest in your business. So,
use their name first.
Yeah, typically you want to, right? And so that's where you leverage advisors, right? You want to build advisors, board of advisors, or there's a nice thing that if you're doing a structured fund, an investment committee, but there's a hedge fund I'm looking at right now, and they potentially are considering this deal that's honestly not a great deal, but a potential investor is the Harvard Endowment, right? And so that's a key piece of getting that investor in, is because now they get to flaunt and say, look at this social proof I have. But yeah, you should definitely get permission, and usually want to incentivize those people. Was that what you're going to talk about, or what were you going to say?
Huge key part of every one of those closings is we had deals we were closing on,
Yeah.
and funding, or we had a massive amount of pipeline that we were pending to finish off and get an LOI. That was a huge value add push at the timing of it to say, we've got to close on this date. It has to be this date. We got people waiting for checks on this date. You've got to be in and close on every one of those.
Yeah, I mean, that's part of like the urgency is real type thing. So, yeah, good stuff. Look, we then, I mean, look, this is over the period of a month, we went from 8 million to 20 million, okay? Because, momentum is key in fundraising. Like, you need to wake up every week and say, what is my key momentum advice or momentum sticker that I'm going to blast at the top of every email, that I'm going to sing this song? Hey, we just closed this deal. Hey, we just, got this new advisor, right? As you're following up with people, because a lot of times you'll have that first conversation with them. They'll say they're interested, and then crickets, right? Like you're not getting any more engagement from them. And do you know how many emails I get every week where people say, hey, Lincoln, wanted to follow up on this and see where you're at? Don't send that email. All right. It makes me legitimately lose respect for that individual. Genuinely. But for the people that say, hey, Lincoln, just wanted to give you a quick update. We just landed this new key advisor. We just closed on this asset. We just raised more money. We just XYZ. Wanted to let you know as you're considering this opportunity, right? Like, that's momentum, right? And people do get FOMO, right? So on our final close, so what's so funny is there's this guy that I went and invited to our very first launch that I knew had, he was a part of a team of a billionaire, okay? And I wanted him to come in on our first close, and I went and, tried to get him on this webinar. He wasn't able to make it. After the first 3 times of following up with him, I kind of pulled back a little bit and said, hey, I want to respect your inbox. If this really isn't something that you're interested in, just let me know, and I'll stop bugging you. And he said, no, like, we'd be interested. It's just timing, right? Like, it's just a matter, matter of making this a priority. We got all these things going on, and that's the reality of it sometimes, right? Like, if you're closing a deal, like, your head's down, like, working on that. I'm that way that sometimes, where I don't even look at my email for like a week if I'm trying to close on an investment, right? And that's part of this industry. So anyhow, like, I followed up, I'm not even exaggerating, probably 30 times over the past year to this guy. And when we hit this point, I said, hey, we are closing this thing. Like, this is legitimately, genuinely the last time for you to get in on this fund, okay? We're wrapping this up, like, point stop. We're not going to be raising another fund for several years. Would love to have you in if it makes sense. And he finally, a year later, introduced me to the right guy. Got on with the CIO, and this is a big family office. And by the way, so for this final close, getting to 20 to about 30 million, we had, I had been working some of these larger families for forever. I think, what did I have, Bridger? I was probably 8 families that were in talks with me, and check sizes of $5 to $10 million to close this out. I had 8 people, right? I was like, I just need one. I just got to get one of these guys, right? These are people that were active in diligence with us, right? That were actively looking at the opportunity. And anyhow, this one guy that 7 of the 8 didn't go through, but this one guy that I've been following up with a year came in for $5 million. And then, we ended up raising more from smaller checks, more ultra high net worths, high net worths. But that was kind of the journey of fundraising, right? Like, you just need to wake up every day and say, how am I going to go get more leads this week, right? How am I going to increase top of funnel? How am I going to create momentum? How am I going to create urgency? And guess what? Like, I already have people that have, said, like, let me know when you're launching Fund 2, right? Like, let me know when the next thing. Because, again, once you raise money, each subsequent dollar gets easier and easier to go out and raise. So you just got to know it's a battle at the beginning. But as long as your deals are good, your investments are good, you'll be on a great path. So.
Some of the other channels that
I tried everything. I went to conferences. I hosted dinners. I paid a placement agent.
Walk through that. Walk through all the people that we tried to bring in to help us raise
Oh
capital.
my gosh. Like, look, like so many, right? Like there are so many different partners that we potentially tried, working with that everyone says they have money. They say they have relationships. They say they have networks. And so we structured a variety of deals with different groups. Now you do have to be compliant, right? There is kind of rules that you have to follow when raising money. That's key to know. And so that's something that we, help people do is make sure that you're compliantly raising money because you do have the SEC looking over your shoulder and, you can't, it's called transaction-based compensation that you need to be aware of. So you have to follow general solicitation guidelines. But look, I don't even know, probably there were at any given time, there were probably 8 to 12 people that I thought were going to help me raise money in some way, shape or form, right? Like genuinely we'd either paid them money or, some sort of agreement in place and, most of them didn't, right? There's something important to know here is that as hard as you want to work, the person that is going to be able to raise money for your strategy, the highest probable individual is you, right? Like whoever has the highest stake in the business, right? If you are the majority partner in the business, it's you cannot not be a part of the fundraising process, right? You might be able to go get people to bring you leads to help close them, and there's processes to follow there. But at some point, you have the highest conviction for whatever it is you're raising money in, and so it's critical that you are still a part of that process, and and that was like a wake up call that I had. I think probably last summer, is I was trying to get other people, to do it, and then I just said, look, I gotta, because I'm a nerd, guys. I'm a financial guy. I'm a spreadsheets, Excel, CFO personnel. That likes numbers, and that was not my cup of tea, but I had to, kind of step into those shoes just because it wasn't getting done otherwise. And maybe, and look, again, everything here is my experience. Everyone has different experiences raising money. You may have a pre-existing relationship that walks in and gives you $30 million. Great for you. That was not the case for me. I was starting from literally zero, and I had to create it. So yeah, I tried anything and everything. LinkedIn outbounds, conferences, events, just all of it. So.
Did you like working with them?
We paid them $60,000, and we did not raise a dollar from it. Part of it.
We looked at 20.
I looked at 20 to 50 placement agents, and listen, I do believe, this placement agent was highly recommended, highly reputable. We only engaged them. We engaged them in October, and we cut them off in March. I strongly believe that of those 8 family offices I was working, I think 5 of them came from that group. Okay, so it's like they were getting me in front of real people, but look, I just had the philosophy of I need to throw as many lines in the water as possible, and I need to generate as much interest if I'm ever going to get this thing raised. So, but yeah, I didn't raise a dollar from it. Most of the money came from my personal efforts at the end of the day. That's what I'm saying. But that was my experience. I do believe that if we were raising $100 million and had continued to work with this partner, because I was talking to a new family office almost weekly with that group. So it was worth it, but it wasn't,
So you've talked to us a lot about your journey, and I think we've learned a lot through your fundraising journey, but what was maybe a mistake that you made that you would do differently next time, or something you learned from in this journey that you would do differently in the future?
Oh man. I don't know if I'd change any of it. And the reason being is because where I sit is we come in and we partner and invest with emerging fund managers. And I literally tried almost everything you can. And now I have that experience that I can go and, advise and work with our portfolio funds and helping, we're not a placement agent in any way, shape, or form, but we partner and invest with funds. And if I can advise them on their fundraising strategies, then that's a win for me. So I'm glad it would, you know, like I don't know if let's see, like I'm grateful for that experience. Key mistakes. I don't know. Is there anything big there, Bridge? I mean, look, I guess something I'd say is, make sure you have good contracts, right? There were, clawbacks, vesting schedules, definitely, have good contracts, okay? And make sure you don't get it taken advantage of, because there's a lot of people that, there's a lot of sharks out there. So I think I had my wits about me just because I've been in the fund launch ecosystem for a number of years. So I think I was good there. One more question, then we're wrapping up.
Well, let's keep going questions. I just want to hit some of these other topics on the screen too.
Yeah.
I don't know if everyone here knows somebody who tried to raise money or sell securities and then lost money and went to prison. But I know people who've done that.
Yeah.
I realize that there's a right way and a wrong way to do this. Can you kind of talk through just in the capital raising process on the front end, how you set expectations? Hey, we want this return, but we can't guarantee this return.
Yeah,
we might lose or whatever.
Yeah, I'll be simple. There's a lot of rules you have to follow. I can't cover those all today. Don't have enough time. But the biggest thing is fraud, right? Most of the time people don't lose money in investments. It's because those individuals are fraudulent and they are self-dealing and they are taking money off the table. This is not investment advice, but I look at a lot of opportunities and I don't invest in things unless there's an annual audit. I don't invest in things unless there's a third-party administrator, okay? These are private markets, private markets offerings. Those are huge, right? Make sure that there's third-party people that have oversight on accounts, because the biggest reason, yes, sometimes people lose money on executing, but that's, you have disclosures for that. That's what your PPM and your LPA and all these docs are for. But most of the time people lose a lot of money is because of fraud, because the manager is dishonest, they don't have integrity, and they get in a pinch and they start taking fund money and using it for other things. So, okay, you want to talk about some of these? Yeah.
So I'm gonna keep linking up here for a sec, and we'll probably stretch out. Yeah, on that question, I just to add. It's okay. It's not okay, but you can lose money in a fund, and you're not going to go to jail. It happens. Some funds just lose money, right? You have disclosures. You have things to do that. When you go to jail is when someone stole the money. Now, what happens when a fund loses money? Investors want to know what happened, and so they'll do sometimes an investigation. They'll say, did we just make bad investments, or the money was stolen? If we just made a bad investments, well, shoot, that just didn't go well. And that's the nature of investing. But if someone actually took the money and bought something they weren't supposed to, or took it to Vegas and tried to gamble to get all the money back, that's why people go to jail. It's not like, I used to think before this, I was like, man, I think just one day someone's going to show up and just send us to jail because it's just you're in this industry. That's not the case. It's blatant fraud, waste, and abuse of a certain thing. And so that's why Lincoln said third-party audits, crucial. All of our funds, we invite auditors every year, and we audit our entire funds every single year. We do third-party administrators. We have them come in and they manage all of our funds to have two sources of proof that we are honest. Like Lincoln said, I don't invest in anything that doesn't have a third-party audit or third-party disclosures there. Yeah. Let's do this. I want to hit. Are you guys doing okay? I want to hit some of these, if that's all right. We had a bunch of topics. We're just going to go rapid-fire Q&A. We're going to go kind of fast. Me and Lincoln can answer. We have a few other people here. Does that sound okay? That'd be useful. Let's do this, though. Stand up for a second. High five two people around you. Just say hello to them. Give them a high five. Say what's up. Stretch out for a second, and then we'll hit some of these in 20 seconds here. Just say hello, and we'll get queued up. Stretch out for a second. There are bathrooms up the stairs right here. Our offices are all upstairs. If you need a bathroom, it's right over there, or through these doors right here. There's a bathroom, and then we're just gonna rapid fire Q&A. We'll make sure we answer a bunch of these questions. Drinks in the back as well. 20 seconds, 30 seconds, come on back.
All right, come on back, come on back.
Come on back, grab a seat. We're going to go rapid fire here. We'll hit some questions, and then we'll hang out after, but let's up some of these. Grab a seat, come on back, come on back. Grab a seat, come on back, y'all, come on back. You guys can, we'll get going here. Yeah, we're going to share a bunch of stuff. We're going to go fast here. All right, has this been good so far? Been useful, worth your time? Okay, if it hasn't been so far, let's hit some questions here. Sound good? Okay, let's make sure your things are answered. We've already checked off a number of these. Let's see, what should we dive into, Link? Yeah, you. Did we cover all these? Yeah, any ones that stand out to you, like, man, I would love to get that. Just shout them out. What would be something interesting? Or if not on the list either. We'll start marking some of these off. What type of fund to do? Somebody threw that out there at the beginning. We had manage a fund, team on your fund, fund to funds, hedge fund incubator, licensing, fund versus SAF, crystal ball. I kind of talked about that already. Cash flow, we didn't talk about this yet, or a search fund. We talked about scale.
Yeah, let's just go through. You have something you have to.
Yeah.
With the difference between like hedge, family office, VC, like why do they take those different classifications?
Yep. Okay, so look on the iPad here. Bam, different types of funds. Like, what are these? What are the definitions of these? So what is a fund? I'll go quick through this. A fund, all a fund is a pool. Oh, wow. Okay, here we go. Let's try again. What is a fund? A fund is a pool of money. Investors are putting money into this pool. I'll put like investor right here. They're putting money into the pool. Fund managers, me and you, we're over here. We draw from that pool and we go make investments. When those investments make money, hopefully they're crushing it, the money flows back to the pool and gets split between the investors and the fund managers. It's like the oldest business model on earth. It's like, hey, we're going to go open up a blacksmith shop, put some money in. Whenever we make money, we'll split the returns. Like, this is from like thousands of years ago. Okay, this isn't anything new. So we've helped people structure all these. So what's the difference then of a hedge fund, private equity, debt, real estate fund, venture capital fund? The difference is the assets they are buying, the investments. That's it. These are pretty much structured almost the same. It's kind of crazy. We work with all of them. So for example, a real estate fund is kind of simple. It's a pool of money that buys real estate. So what's a private equity fund then? It's a pool of money that buys private equity, private ownership in businesses. So they, instead of buying public business, they buy private businesses. A great example is Sycamore Partners on Wall Street. They bought Staples Department Store, Nine West Shoes. They bought Aeropostale. Last year, they're trying to buy Kohl's Department Store. That's a private equity firm at a large scale. Small private equity would go buy HVAC companies. You're buying private ownership. Okay, so what's a hedge fund? Instead of buying, it's a pool of money, just like before. Instead of buying private companies, it buys public companies. It buys stocks, bonds, options, Forex, crypto. But they're all kind of the same. I mean, there's nuances to each one, but they're structured pretty much the same. Debt, or what we'd call private credit. It's a pool of money. They lend money out. They do loans. Venture capital, they invest into early stage startups. They're almost the same. They just classify themselves differently based on what they do. The last part of your question was like family offices. It's a pool of money from one family, and it's that family's investments, right? And usually they hire a management team to help make those investments for them.
A multi-family office is where there's multiple families collectively putting money into a vehicle that are then deploying out of that vehicle.
Awesome question. We're gonna go. We've been told to try to go faster. We're gonna try to speed up questions here. Yeah, go ahead.
Find somebody to manage a fund that I'm involved in. What's the best, I guess, criteria in terms of looking for somebody that
Like a partner?
Yeah,
How do I find a partner to help me manage the fund?
An ideal manage.
So there's 3 distinct roles. This kind of answers this question. Something on here was about partners team. There's 3 distinct roles in every fund. You guys see that? Okay. I call them your expert investor, your fund manager, and your money raiser. Pretty somewhat self-explanatory. The expert investor is very, very good at gyms or online influencing, whatever it is, or trading options or buying real estate or whatever it is. Fund manager, very, very good at like compliance, legal, regulatory stuff, licenses, like how it runs, the fund runs. And then finally, money raiser. This person's very well connected. Natural born salesperson can raise money. Pretty obvious there. So these 3 roles. Now it could be 3 people. This could be 20 people. It could be 2 people. In my fund, Dan Young, my partner, really, really good at crypto. Incredible crypto person. I'm very good at fund management. And then we both raise money together. That's kind of how we work. Fund Launch Partners has a different structure. We cover all 3 of these roles. So the question is then, how do I find those partners, right? How do I find them? I'll use a dating analogy. What's the easiest way to date a 10? On a scale of 1 to 10. What's the easiest way to date a 10? Be a 10. The easiest way is to be a 10, right? 10s want to date 10s. 7s kind of date 7s. Now, sometimes a 6 will date a 10, and we make movies about it. We put Adam Sandler, and he dates some supermodel, and it's awesome. We love it, right? Because it's so unique, right? It's like, oh, that's awesome, right? But generally speaking, 10s want to date 10s. Business partners who are level 8, 9, 10 want to have business partners that are also level 8, 9, and 10. And so sharpen your own axe, right? If you want to have a level 10 partner, be a level 10. My partner, Dan Young, is on the board of Intel for the last 16 years. Board of AMD for 4.5 years for their gaming advisory council. Done hundreds of millions of dollars in sales. He's twice my age. Why did he want to partner with Bridger? Maybe I'm a 6 that dated a 10. He's like a level 10 entrepreneur. He's awesome. But what I showed him, I had expertise in an area. I was a level 10 in an area that he knew nothing about, which was fund management. He knew a lot about crypto, a lot about investments, a lot about business, but he's like, man, I don't know how to do a fund. So I was a level 10 in that category, partner with him. You see this with companies that have like this young kid that's a really good coder. They're really good at coding. It's like, okay, well, he's a partner because we don't know how to do that. He's going to be our CTO, right? He has expertise. He or she has expertise in something we don't know about. So that'd be a quick answer. That help? Is that helpful? So at Fund Launch, we go really, really deep on fund management. We go pretty deep as well on money raising. An expert investor, we kind of leave that up to you. We give frameworks and stuff around that. We most people at Fund Launch, we kind of train and really, really help these two. We kind of help here, but most people that come to us, they already have an idea. They already know. A lot of you already have ideas. Come to us. We'll help you figure out fund management, money raiser. Mm-hmm.
Where like your complementary skill sets are.
Try to get really, really good at that thing. I love it.
Yeah.
Sweet.
Absolutely.
Keep going. Other questions. We're kind of go rapid fire here. What can we help you with? We can hit some of these too, but yeah, go ahead.
Not to really engage with non-accredited investors just because they're a lot of work. Is that still kind of your starting out? Like that's all you know. Like how would you?
Yeah, good question. So should I engage with non-accredited investors or accredited? You want to take that? I've taken the last 3. You can take it. And I think there's a little framework I have here. Number 1, you can. I'll say too, you can do a Reg A fund, but just most don't because of certain reasons. I'll let Lincoln answer that.
Look, I'll be honest. Some of the $200,000 investors in this fund are way more work and a way bigger pain in my ass than the $2 million or $5 million investors. All right, and so the scale goes up, right? Like the smaller investors are just more work. You know, it's more of their money. They don't invest in that. They're calling you when they get their statements and saying, what the hell, you know, what's going on here? You know, my accounts, what does this mean? What does that mean? You know, and it's just a lot of work. And look, if you have to start there, great. I mean, your first fund was $60,000, you know, a couple of $10,000 checks or something. Yeah. I mean, but you got to start somewhere. And so but just know that it's usually the same amount of time and effort. So I would say not ideal, but if you're not able to get any larger investors, it's better to start with something, right? It's kind of that momentum, get moving, get dollars in the door, get assets under management as quickly as possible, because that's going to scale.
These are the types of investors on the screen. So if people don't know, there's non-accredited investor, then there's accredited. There's 2 tiers above, qualified client and qualified purchaser. You can see the net incomes. Essentially, what the SEC has said, if you're not a millionaire, you're an unsophisticated investor. Most funds don't raise from non-accredited or non-sophisticated investors because the SEC has made extra rules as well to raise from them. So if you go raise from non-accredited investors, you have to over-disclose to them. You have to give them like triple, quadruple the information and requirements because the SEC deems them, these are, you know, people that aren't millionaires yet, and they need to be related. Like, think about a public company. It's a public, non-accredited investors can buy public companies. They have to disclose so much stuff. When you raise from non-accredited investors, in some vehicles, you have to disclose a lot more to them. It's a lot more work. So they're harder to deal with, and they're more work to like compliance and be filings and stuff. And so most funds, both of our funds, we only raise from accredited investors or above. Traction. My new fund, we only raise from qualified purchasers. You have to have a $5 million net worth to invest in my fund. Yeah. But yeah, you can start. You can start small. You got to start somewhere. There's a Reg A, Reg CF funds. There's also Reg D funds you can raise from. Brent Mott raised 35 non-accredited investors, did really, really well with this. He disclosed the right way to him, make sure his lawyers have done the right way, and just got started. I think there's a lot of validity to that. But generally speaking, there's a lot of accredited investors. People ask that question like, well, my uncles and cousins are non-accredited. It's like, there's actually a lot more accredited investors than you think. The average baby boomer is a millionaire in the United States. The average. I don't know if people know that. The average baby boomer is a millionaire in the United States. There's a lot of accredited investors walking around you every day. You should have no idea. There's a lot more people with money than you would think. Even in little old Utah right here, there's a ton. So, yeah, we'll keep moving on. Did you have a comment? Yeah.
I was wondering, just on that, who verifies that and who's accountable for verifying that? Like, do they have to show you their bank account?
Yeah, so how do you verify this? Good question. Under fund types, if you're a Reg D 506B, which is the most common fund type, they self-verify. They actually check a box on your subdocs, just says, yeah, I'm an accredited investor. They check the box. The burden of proof is on them. So they could lie. You don't know, it's not on them. But a lot of times funds minimum is like, hey, our minimum is $100,000 to join our fund. So they got to have some money there. Now on a Reg D 506C, now the one thing on his, you cannot advertise these funds. This is, by the way, I would say 98% of private money in the world is raised through this, a Reg D 506B fund. They cannot advertise. That's why you don't see ads for Blackstone. You don't see ads for KKR. It's against the law for them to publicly advertise their funds. Isn't that interesting? I'm talking trillions of dollars that get raised. They literally can't advertise, and they self-verify. It has to be done through word of mouth. There's a kind of a relatively new fund type, Reg D 506C, which is here. We are both 506Cs. We can publicly advertise our funds. Okay? So we can publicly advertise, but every investor that comes in has to be accredited, and we have to verify that they're accredited. So when someone joins my fund, generally speaking, we send them a little. We have their CPA or lawyer sign a document. Hey, Joe Smith over here is an accredited investor, and their CPA or a financial advisor signs that, gives that to us, and we now verify that they're accredited investors. Does that make sense? Is that helpful? Cool. I like it. Cool. Other questions? I'll let Lincoln take the next ones. What else? What else can we help you guys? We can hit some of these too, but what would be useful for you guys right now?
So with the difference between a 506B and a C, is there like I'm trying to raise a debt fund. So as far as like licensing, SEC, or like securities licenses, is there requirements, differences between a B and a C as far as licensing
Really,
goes?
it's those things we just walked through. It's a fundraising function, not a strategy function. Yeah, and so really nothing crazy there. But we're not attorneys, and this is not a legal advice, you know.
It's
so
a real estate debt fund. So pardon my.
So there's other options.
There's other things that happen. So how much you looking to raise?
$1 million to start.
Okay, so $1 million.
Yeah.
So what happens? And so this is the big question: like, do I need a license to run a fund? The answer is it depends. We're not legal people, but I'll just share you what I have learned for me. That's what I use for me. Okay, there are 3 different kind of buckets most funds fall into. You have the IA, which is investment advisor bucket. This is if you're under 150 million. You are at the state level. You would potentially need a Series 65. Now, every state is different. So you're in Utah. I'm not sure Utah's laws for that specific sector, and they have different laws for hedge funds or venture or private credit. So you have to look up Utah state law. I believe you're good. That's my belief, but I would go look it up that you don't need a license in the state of Utah to raise capital. The license you would need, though, is a Series 65. Okay, that's the license. That's what it's called. Now, once you hit over 150 million, you would become a registered investment advisor. You file with the SEC, and you would need a Series 65 as well to earn a fee for giving investment advice. You become an investment advisor, is what it is. Like just like your brother-in-law, that's like your investment advisor. It's the same license. It's called the Series 65 is what you'd need there. Now down below, if you're between 25 million and 150 million, you can file as an exempt reporting advisor. And you're under the SEC and you don't need a Series 65 here. That's what we actually both qualify for this, and we don't have licenses right now. Once we hit 150 million, though, we'll have to become a registered investment advisor and get Series 65 licenses. So you're in the state of Utah. You may or may not need a 65. That would probably be the one license you would need. Now, the one exception to this is if you're running a hedge fund and you're trading securities, putting leverage on securities. CFTC has license. You want to talk about that?
Well, yeah. I mean, I don't want to dissuade anyone, but I would say the hardest vehicle to start is if you're trading commodities, like a hedge fund, because you're not only regulated by the SEC, but you're now regulated by the NFA and the CFTC, and there's a bunch of different licenses and regulations that you got to be aware of. So, look, we've tried to, make this as simple as possible because it is intimidating and it does depend. And so, that's what we've been doing for the past 5 years, is trying to make this as simple as possible and, to cater to everyone's scenario.
Is that useful? Is that helpful? Yeah, a little bit on licenses. The cool thing is, though, like a lot of funds can launch without a license. It's actually pretty cool. You actually can, now you still have to file. You have to file your notices and all. There's a bunch of stuff you have to file, but you actually don't need a license as well, which is kind of cool. Yeah.
At a time, like, is it you focus on one fund and close that out after a series of years, and then you start another one, or?
Great question. The answer is yes. Yeah, you want to hit that? Maybe draw the life cycle of funds. Yeah, that'd be kind of cool.
Well,
is the iPad better? Or do you guys like the whiteboard?
iPad fine. Okay, so there's difference between open-ended funds and closed-ended funds, but let's see. Let's get this a little bigger here. I'll try and go quick. Sorry if I'm pontificating a little too much. But look, at an open-ended fund, you launch and it's basically there forever. So open-ended hedge funds, as long as you're managing money, you're running that vehicle. You might launch a new product or a new strategy. Whoops. This might be like an income-related strategy, right? And this one might be like a stable yield, related strategy. Whatever the investors want, right? This might be those are the same thing. So this would be a growth-oriented vehicle that has higher risk. So for us at Fund Launch Partners, we launched Fund 1, right? We're fully raised, and now we're deploying that. We're going to deploy that between this year and next year. And then as soon as we're done deploying capital out of this vehicle, We're going to raise another. I mean, we're going to still manage these assets for about 6 to 10 years, but right here at about year 2. So we just had an offsite a couple weeks ago planning this. We're going to launch Fund 2, where of the same strategy, but as soon as we're done deploying out of Fund 1, we're going to be deploying out of Fund 2, right? But we have several other strategies that we have in mind, like that first one I talked about, the anchor vehicle, like a $200 million fund of funds that we might launch in here as well. But it's a different product, right? So like if you think about it like a business, we'd launch a new product right here and then manage and operate that. So that's how these businesses grow and scale, is multiple products. There's some groups that just stay the same product for the rest of their tenure, and I mean, look, you can make a lot of money doing that, and you can build a great business. Some people want to expand, so yeah.
I'll keep drawing here for a sec. So yeah, you have fund. You'll hear like people like, we're on Fund 7. You've ever heard people like, oh yeah, we're on Fund 5. Venture Fund 5. Generally, like Lincoln just shared, I'll move this out of the way. On this, to just draw this out, how this like looks. These are, let's call this a 10-year time frame. You got Fund 3. So we're in a capital raise part of the fund here. We raise, and then we close our final closing like we just talked about. We're now in a deployment phase of our fund. So we're deploying the fund. And then at the end, we're kind of, disposing or exiting position. So if you're like buying real estate, you raise the money, and deployment, they kind of mesh here. You start deploying here, you're deploying, and then you start exiting these positions here. Does that make sense? As we're done with that, Fund 2 kicks off, and we are raising capital with Fund 2 at the same time that we're deploying Fund 1. Like these match up together here. And then we would hit a deployment period here. And then we have an exit period on Fund 2. And then, ta-da, we then, right as we're done here, we're opening up Fund 3. And so if you paint this out, what's going on is we're now running 3 funds at the exact same time. Let me draw this out real quick. Yeah, sometimes you don't want to cross over assets because you want to be a true fiduciary. You want to do the best for your fund. So a lot of times Fund 1 is not buying the same assets as Fund 2. Oh, your investors.
Your investors can reinvest in
Yeah.
Fund
These
1.
investors here, are, if they have a good experience, they're like, oh yeah, we'll pile into Fund 3. And so at the same time that you're buying in Fund 3, you're deploying in Fund 2, and you're exiting in Fund 1. Does that make sense? So you have a full team here. Most funds, they kind of say you don't really know how good a fund is really till Fund 3. Most institutional investors wait till Fund 3. That's where you make all your money. Really, Fund 1 and Fund 2 in most closed-end vehicles is track record. This is even track record. And then by Fund 3, this is where most funds, like that's where they take off. They scale, like they've raised billions of dollars, they take off, they're taking over the world. Because a lot of institutional investors go, well, we don't know if you're good yet, right? This is a long game. We talk about the game of funds. This is not a get-rich-quick scheme. This is a 10, 20, 30-year plan. But if you do it right, the Forbes 100 list, the number 1 asset class of billionaires is this. That's how most billionaires made their money. It's right here. Number 2 is tech. Number 3 is fashion. This right here is the number 1 vehicle most people made their money. Isn't that kind of cool? Yeah. Question?
When you're raising the money and then you've closed it and you're deploying it, isn't there money burn there? Or how do you set that up so that you're not, because a lot of funds have this money burn where they raise the money.
How do you manage the cash flow, the timing, all that kind of stuff? Capital calls.
Because you pulled all the money in, you're paying your preferred return on that money, but you haven't deployed it yet.
Great question.
That's the key distinction. Yep. That's the key distinction is in most private market funds, you're not deploying all the money. So I've only called on my 30 million that we've raised. I've only called like 2.5 million, I think. And it's a drawdown fund. So as I deploy the capital, I issue what's called capital calls. So I send out a notice to investors. We have one coming up. We're going to call about another $1 million in about a week. I'm going to send a notice to all of my investors and say, hey, based on your commitment You know, if you put in, I don't want to do the math right now, or I can't do the math right now, but you know, you're 7% of your $1 million commitment, so you're sending us $70K, right, into the door, you know, and then we're going to take that money and turn it around. So you're continuously calling money in as you're deploying the capital, but I don't need all that money right now. I wouldn't, as you said, I don't have a place to put it.
I understand that. However, when you need that money and then all of a sudden their financial situation has changed and all of a sudden they're like, I can't, I know I committed for $1 million, but I'm not investing anymore, or I'm only doing 250,000.
You put the question is, people virtual. What do you do if people can't fulfill capital calls? So you're calling capital down, and then people's like, I can't make it. You put steep penalties. So this is what every big fund in the world does. There's big penalties. If you subscribe to my fund and miss a capital call, it's a 50% penalty on everything you've committed. So if you've committed $1 million and you miss a capital call, you have a penalty of $500,000 legally that you need to pay us, or you lose your whole investment in the fund. And you tell them that up front. It's in the docs, and you actually got to verbally say, hey, if you're going to commit $5 million, we're going to be doing capital calls. We plan to call 10% next month, another 10% next quarter. If you miss a capital call, it's a 50% penalty. Are you good for that? Yep, I'm good, Bridger. Okay, great, let's do it. It's a big deal because if they miss a capital call and you can't close on a deal, it hurts your reputation. That's why you put such steep penalties. My dad's funds, it was a 50% penalty. They're a $50 billion fund. These are big funds do this. Yeah. Follow up on that?
50% on their entire commitment or the call itself?
On their commitment. So it would be pretty much all the money you've now given. So let's say most funds, like they'll call a certain percent at the beginning. They call 5%.
Sorry, if you don't fulfill on your next capital call, that 5% is ours. Like you lost it, right? We could. Now, this is a reputation game, right? And so there are scenarios that happen when people hit liquidity, even at the institutional level, right? Where they hit a liquidity crunch and they say, hey guys, like, and usually that's like on a per relationship basis. Like, hey, I can't, if you are issuing a capital call, I can't deploy anything for the next 3 months. And they work something out, or maybe there's a penalty, maybe there's not. Because at the same time, if you burn that bridge is burned, right? And so it's just kind of it's at the sole discretion of the general partner. Yeah, or you can sell, right? That's a great thing. So secondary. So if you made $1 million commitment to a fund, there is this entire ecosystem of a secondary market. There's funds that all they do is they say, oh, look, you have $1 million commitment in a fund. You need out. I'll come in and buy it for 80 cents on the dollar. Right, so I'll come in and I'll give you 800,000, and I'll take your position because you lose half, and so there's you can get out of this. It's either GP led or LP led secondaries. So there's a whole market for that. Now, it's not the general partner's problem to facilitate that. And look, with a $200,000 investor, it's a lot harder, right? But with bigger money, it becomes actually a lot easier to get that replacement.
We had a guy 2 years ago, COVID, whatever. He had $1 million in our fund, needed out like right now. We said, well, it's a 50% penalty. We said, let's see what we can do though. We asked around. Somebody came and bought his position for $900,000. It's 10% discount, and he was liquidated out. And then that new person took his position. Yeah, we did that last year. Okay, good questions. What else? Yeah.
We do it. Asset-backed lending, so people are putting everything in. We're not calling for more usually. So when they're committing, not in that situation, when they're committing to $1 million and you're calling for 10%, they're managing the other 90% themselves. They've just committed to it, right?
Yep.
You're not actually holding that money in management, or could you?
Well, I don't want the liability, right? So why do we do capital calls? Well, you can earn 4.5% in a money market account, and you're good. And I don't want to start the counter on my IRR clock, because once I call that money, I'm now on the hook to like produce returns. Now you're saying your call 100%. My fund's the same way, so I call 100% day one. We're a hedge fund. So we, on crypto, we call 100% day one, and we just deploy that in the market. My dad ran a private, like a hard money lending fund back in 2003, 4, and 5. They would call 100% of the capital day one, and they would just wait. Because hard money lending funds, private money lending, you got to have money to go like tomorrow. You can't wait 10 days for a capital call. So what he would do, this is what kind of would say, he's like, he would just have a pile of cash sitting in his bank account. And someone would call him, John, I'm in a pinch. I need $3.8 million by Friday. Can you help me? He's like, yeah, I can help you. Okay, it's going to be 4 points and 14% interest. And they're like, oh, that you're a loan shark. And he's like, I don't know. I've been sitting on cash for 4 months waiting for you to call me on a Wednesday, and you need money Friday. So up to you. And I got to pay my investors their pref and premiums and stuff because we've been waiting for your phone call. So what do you want to do? And they grovel, well, he said, you don't take the deal. This is the deal, though. And they would take the deal, and they'd fund on Friday, and they'd close, you know what I mean? So that's how he ran his fund. Yeah, it's like, well, what other options do you have? So that's how they ran their opera, and a lot of hard money lenders do that kind of thing. But you have called the capital, and your clock has started, and you're sitting on cash just at zero, or maybe a money market account, waiting for someone to call. So, yeah. Oh, it is noon. Okay, let's break here. One more. Yeah.
So typically it's like $250,000 to run a fund for a year, based off my estimates. But if you're doing like a hedge fund incubator, how small can you get that sunk cost?
You're saying operating costs to run a fund? So your estimates are about $250,000 a year to run a fund. What kind of fund? Hedge fund?
Incubator hedge fund is what I want to start. So I just wondered how low can you get?
I don't think it costs that much. No, not at all. So it's funny. If you go Google how much to run a fund, it depends on the fund, right? How much to start a fund. And now that being said, like with Fund Launch, for example, if you go Google right now how much to launch a fund, Google will tell you $40,000 to about $80,000 just to launch. And then ongoing maintenance, $100,000, $250,000, $300,000. We've launched hundreds of funds. We've gotten pretty good at the process. We have the Fund Launch formula, like I guess we can show here. The way we think about it, I'll go here. We run people through a pretty significant process on how funds are built. So number one, on the launch side, and I'll get to operating costs. When I go launch a fund, like our last fund, I know how funds work, like really well. Lawyers bill by the hour, right? So I call my lawyer. I'm like, hey, you bill by the hour. He's like, yeah, it's usually $40,000 to launch a fund. I'm like, hey, I've already figured it all out. Like, I know exactly what I want. Can you just build this for me? Oh, cool. Saves him a bunch of time. He launched our fund for like 10, 12 grand. Pretty sweet, right? I have a friend did the opposite, spent roughly $400,000 or $500,000 launching his fund because he went to his lawyers first. They built him a fund. Then he's like, oh, I want to change something, and then change this, and I learned this new thing, and just change this and change this and change this. And the lawyer's like, great, I'll bill you by the hour. Changed $400,000, $500,000 to launch his fund. Crazy, okay? Same kind of docs, right? These are big docs you're getting. So that's on the launch side. Now, ongoing operations of the fund, like what are the costs associated with that, especially for a hedge fund? Our fund is we'll just share real world. My fund's when we launched, it was 10 million. Now we're up to about 25 million, in that range. We're crypto, so our insurance is much higher. Operating costs for security, we have a ton of security we pay for. And then ongoing running the fund, I bet we spend $100,000 to $115,000 a year total. And that's in a crypto fund, which is very, like, we're paying triple because insurance doesn't want to insure us. You know, just everyone doesn't want to work with you when you're in crypto. Hopefully they will now. Now tell us about Fund Launch Partners. Yeah.
Yeah, ours is very lean, right? Like we are load cost is so important on an emerging fund. Like it can hurt you, right? If you're only managing, it's called $1 million to start, and it's costing you $250K a year, that's a 25% hit before you're in the money, right? Like you don't want that at all. Like every point matters when you are starting out, and so that's why we've spent years like researching the most cost-effective, service providers and solutions to get that load cost as low as possible. I mean, Adam would know the number better, but it's definitely ours for our fund. It's well below $100,000, if not below $50,000 a year in operating costs, to run that. So, and that's load cost on the investors. Now you have management fee on top of that, but yeah. Okay, I gotta go.
Yeah, you can head out. I'll share too. So this Fund Launch formula you see here clap it up for Lincoln, by the way. Clap it up for Lincoln. Well done. He's running to a lunch right now with the person. So we do a lot with like partners and getting the right people to make that cost effective. The thing that we do, we run this through a thing called Black Card is what we call it. That's like our incubator launch funds. So we do this day in and day out. We have 8 different law firms. We have like, I don't know, 25 service providers that we all negotiate discounts with them to work with them, etc. So you guys are amazing. If I can, to wrap this day up, hopefully this was useful. I'll stay here for a few minutes. We got a few of my team members as well if you guys want to just talk and just chat more about funds. We help people like crazy launch funds. I try to do a lot of just free content and free stuff like today. Was today worth it? We're hopefully worth your time to come learn a few things. We probably, thank y'all. We probably will throw this, we're kind of thinking like once a month. So come back, bring friends. We'll do different topics each time. We'll kind of switch it up. Some of you guys came last time. We kind of, today was a little bit similar, but a little bit different as well. We might keep switching it up because I believe more people need to understand what funds are. And if you're like, Bridger, what's the catch? Like, what's the catch on this thing? The catch is, I believe if I just teach enough free content like crazy and educate the masses, number one, I'll just make the population smarter on funds. Number two, hopefully one day when you're ready to launch a fund, you'll give us a call. So our product is Black Card. It's $20,000 to $45,000. We do, it's a full, everything, that's including your legal costs. That's including all the coaching, all the pitch deck design you can see here. We do 4 events a year. We have asset class tracks. You join 1,200 other fund managers. We have a full academy. We have pitch deck design. We have a full back-end software, Fund Launch 360, that manages your fund with you. And then we have legal and fund formation. The fund is built, everything to launch. And then post-launch, how do I run it? And we have a bunch of discounted partnerships like you could use for your incubator, for example, to go out and launch. It's kind of like having a full team like this with a coaching staff, account managers. We place interns into your fund if you want that. We have a legal team, softwares, everything inside your fund. So now this is not for everybody. I mean, it's for people that want to launch a fund. It's a significant cost, $20,000 to $45,000 to launch. This is not for everybody. Most people that come and watch our free stuff, it's just like for free. Like I just want to educate the mass. I want more people to understand funds. But in 3 years, 5 years, 10 years, when you're ready to launch a fund, give us a call. That's the, if you're like, what's the pitch? There's the pitch. There you go. I really believe in democratizing Wall Street. Like I really believe we need more people to understand this game to run good funds. We talked about fraudulent funds. We need more people to run good funds that are compliant, that do audits, that like are awesome. And by the way, all of you probably one day are going to invest into a fund. And maybe you'll invest in my fund. Who knows? And I want you to know what to look for, what to see, ask questions about audits and team and fund structure. And hey, did you do that? Like if you know what you're talking about, you can be a much smarter investor and make better decisions. And overall, we'll have a better ecosystem of funds in the universe of funds. There you go. There's the pitch. Does that sound good? I think we need more people doing this. So if you can, as a thank you, if you had a good time today, by the way, I'll throw my, if you can tag us, if you take a picture or tag us on Instagram, that'd be a thank you. And maybe just say, hey, come to the next one. We're going to try to get, I don't know. We'll see if we can pack this whole house here in 6 months. We'll see how it goes. But my Instagram is @BridgerPennington. So Bridger_Pennington. And then our other one is Fund Launch, just @FundLaunch. If you can just tag us, that would be the thank you for today. If you had a good time. If you didn't have a good time, then don't do it. Whatever. We're good. I'm okay. I'll recover. It'll be fine. We wanted to start doing these. Like, why not? It's just kind of fun. Let's let people come by and talk about funds. So I'll hang out for a few minutes. We got a few of my team members here you can talk to as well. And you guys are amazing. Thanks all for coming today. See y'all later. Bye-bye.